Okay, hello everyone. Hello and welcome. I'm Helen Miller. I'm Director of the IFS. I'm thrilled to see you all here this morning. So hello to everyone who's here in London. Hello to everyone who is watching us online. We've put together an event today all about why housing in the UK is so expensive, the consequences of that, and importantly, what the government can do to try to make housing more affordable. This is clearly a really big issue. You know, the homes we live in have a massive impact on our lives for all sorts of reasons. And as all of you who live in the UK will know, housing is not only extremely expensive. I think the latest data, house prices in England are nearly 8 times higher than median earnings. But for that price, we tend to get actually pretty old, pretty cramped accommodation. So it's clearly a really important issue. So today we're going to set out some new evidence from IFS work on the effects of the Help to Buy schemes. You'll hear that this morning. We'll have a keynote on why UK housing is so expensive, and then a panel discussing what can be done on housing affordability and thinking not just about financing schemes, but more broadly about house building and planning. Along the way, we'll have time for Q&A. So for those of you in the room, we'll have a roving microphone. For those of you online, you can pop your questions into Slido. We'll take a mix of in-person and online questions, so do pop them in and vote for the ones that you'd most like to know the answer to, so we can prioritise those. I'll be back after the break to chair some sessions, but for now my colleague Lawrence O'Brien is going to chair the first session. And the last thing I should say is a huge thank you to Homes England, some of whom are here today, who have funded the IFS research you're going to hear today and allowed us to put on this event. So thank you to all of our Homes England's colleagues for all of that. But without further ado, let's get on with the show. Lawrence.
Thanks, Helen. So for the first session, we're running from up until 10. We're going to start with Bea Boileau, a research economist at IFS, who presents some of our research on how governments can make housing more affordable. We'll then have Ken Gibb responding online, who is Professor in Housing Economics at the University of Glasgow and Director of the UK Collaborative Centre for Housing Evidence. And we'll finish with a bit of Q&A, as Helen said. Do feel free, if you're online, to start putting your questions in Slido whenever you have them. And we'll also have questions from the room at the end as well. So, Bea.
Thanks, Lawrence, and good morning, everyone. Thanks for coming along to our event today. I'll be talking about our new research on the effects of demand-side housing policies on housing affordability, thinking in particular about the effects of the Help to Buy schemes introduced in the UK, and who in particular was helped in terms of housing affordability by these schemes. This is joint work with Peter Lavelle here at IFS and with Lucas Conwell at IFS and UCL. I'll start off by motivating why we're thinking about these policies and this kind of policy area in particular. In the UK, alongside other similar countries, we've seen rises in house prices and falls in home ownership rates in recent decades. So in the UK, over the last half century, we've seen a doubling of the house price to earnings ratio, with house prices going from around 4 times gross earnings on average to an average of 8 times gross earnings. We've also, at the same time, seen a fall in home ownership rates, and that's happened particularly for young adults. And it's also happened particularly among those whose parents don't own their own home, meaning we see a growing gap in housing outcomes between those whose parents do and don't own their home, and a growing intergenerational persistence for that reason of housing tenure. Partially motivated by these facts, we've seen increasing interest in home ownership, the determinants of home ownership, and in the effects of housing policy. So one of these being kind of demand-side housing policy on housing outcomes. Examples of demand-side housing policy include the Help to Buy policies in the UK, about which much more later, but there are also similar examples of demand-side policy being introduced internationally. The effects of demand-side housing policies aren't kind of fully or completely understood, and some concerns include that the benefits of any demand-side policy might flow to people who would have bought anyway, and the overall effects, whether on home ownership or on housing affordability, will just depend on the supply of houses for sale. But despite the overall effects, or no matter the overall effects, these sorts of policies are likely to have important distributional effects, and it's these distributional effects that we're particularly interested in this work. So in our research, we think specifically about these Help to Buy schemes that were introduced by the UK government in 2013. And we consider how these schemes affected housing affordability for different individuals. So we'll think in particular, and I'll show you evidence on splits by income, by parental background, and by location. But an an advantage of the metric that we developed to assess housing affordability is we can look at relative affordability impacts for a range of different groups. In order to look at this, we use data from a representative household panel survey, Understanding Society, and we think in particular about people who don't own their own home, who are in their 20s, 30s, or early 40s, living in England in the early 2010s, just before these policies are introduced. And I'll start by telling you a bit more about what these schemes that we're looking into actually were. So we're thinking about two Help to Buy schemes that were introduced or announced in the 2013 UK budget. These were aiming to increase access to house purchase with a 5% deposit and aiming to boost home ownership as well as to stimulate house building, particularly for the element of the scheme that applied only to new build purchases. The value of homes that could be bought using these two main schemes was capped at £600,000, and both schemes were open to both first-time buyers and existing homeowners, although in both cases they were mainly used by first-time buyers, and we really focus in on the impacts on first-time buyers in our research. So first, we think about the mortgage guarantee scheme. So under this scheme, the government guaranteed a portion of losses on high loan-to-value mortgages offered by mortgage lenders. And this scheme relaxed the loan-to-value constraint on the house that you could buy by meaning people had to put less down as a deposit. But importantly, it had no effect on other constraints to do with how much you can borrow. So in particular, this scheme didn't reduce the size of the mortgage that had to be taken out to buy a given property. So it didn't have any effect on restrictions like the loan-to-income constraint. We then think about the equity loan scheme, under which those people buying new builds in particular could access a 20% equity loan, interest-free for 5 years, and would only need to put a 5% deposit down. And this relaxed the loan-to-value constraint by meaning that people only had to put down a 5% deposit, but also meant that for a given house, people had to borrow less as a mortgage, so relaxed the loan-to-income constraints as well. And I'll just give you a sense of the kind of scale of these schemes by showing you the number of house purchases completed using both schemes between 2013 and 2019 to 20. Here I'm showing you the number of house purchases in England completed using the equity loan scheme over time. And we can see that the use of this scheme was kind of steadily rising over time. In contrast, house purchases completed using the mortgage guarantee scheme show a slightly different pattern. So there was a kind of spike initially when the scheme was introduced, followed by a falling back thereafter, and the scheme stopped operating in 2016. And to give a further sense of scale, at the combined peak of these schemes, so in 2014 to 15, they accounted for approximately a fifth of first-time buyer purchases in England. So kind of relatively large, but not kind of massively so. So these are the two schemes that we're thinking about. And in order to assess kind of how these schemes might have affected housing affordability for different groups, it's important for us to be kind of precise and define what we mean when we talk about housing affordability. So in the next few slides, I'll talk a bit about what we're actually talking about when we talk about housing affordability and the method that we're actually going to use to assess this. So we're defining affordability in this work broadly as the possibilities that people have in terms of the houses that they can afford. And we think in particular about two kind of key metrics when thinking about housing affordability. First, there's the highest value house that people can afford to buy based on their income and the estimated maximum deposit that they could afford to put down. And then second, and very relatedly, there's the share of properties that are sold in their local area, specifically their local authority, for prices that are below this maximum. So giving a sense of what proportion of homes they could potentially be able to afford under the constraints that bind them and with their resources. And the steps that we kind of take to estimate this is broadly, we start by estimating the maximum deposit that we think each non-homeowner could raise potentially. We then translate this maximum deposit into a maximum affordable house price using the borrowing constraints that bind people before and after the policies, and also using people's maximum deposits and their incomes. And then finally, we map this maximum house price to local house characteristics in order to calculate the shares of properties that are affordable in someone's local area. And these housing characteristics are really importantly, first of all, the kind of prices in their local area, and then secondly, the share of new builds that are available in their local area, which will determine how people can benefit from the equity loan scheme. And I'll go through a bit more detail on kind of exactly how we're doing each of these steps in the next couple of slides, but keep in mind these kind of three intuitive steps, which are broadly how we're approaching this question. So we start off by estimating the maximum deposit that someone can afford, as I said. And we do this for each individual based on similar-looking individuals who have recently bought a house. And this is a really good advantage of our panel data that we use. We can observe people who move into home ownership, look at their characteristics, and use this to estimate what people who look like them might therefore be able to raise. To be specific, we're using a set of observable characteristics in our panel data, things like people's education, their household composition, some parental characteristics. And something to note here is that this means that we estimate kind of larger deposit capacity than would be implied by using self-reported savings at a single point in time, which is what lots of past work on these sorts of things has used, including past work by us. And this is because it's a slightly different exercise. So we're here accounting for the actual deposits that people are able to put down, thus accounting for things like faster or additional savings that people are able to make just before they move into home ownership, so if people are able to speed up their savings, and also accounting for other sources of deposit finance beyond just people's self-reported savings. So think, for example, about external transfers, for example, your parents giving you a gift of money to add to your deposit. We adjust our kind of estimated deposits to account for the fact that the people that we see buying a house are likely to be a selected group in ways that we don't observe. So might be able, for example, to have, or might have larger unobserved wealth than others who we don't see buying a house. And we also account for unobservable differences in deposit capacity by simulating many draws of the potential deposits people can put down and averaging across these draws. So armed with our maximum affordable deposit, we then translate this into a maximum affordable price. And to do this, it's helpful for us to think really about two constraints which determine how much someone can afford. First of all, there's the deposit constraint, under which the deposit must be a certain share of the house price you can buy. So a 90% LTV constraint, for example, means that you need to put a deposit down of at least 10% of the purchase price. You'll recall that under the Help to Buy schemes, people had to put down a deposit of just 5% of purchase price, so relaxing the deposit constraint to some extent under both schemes. There's then the income constraint, under which determines the maximum mortgage that someone can borrow. So under this, people can borrow only up to a certain multiple of their income. For the period that we're thinking about, this was generally up to 4.5 times gross household income, and that's what we use in this work. So we use people's estimated maximum deposit, we use their income, and we use the constraints that bind them pre- and post-policy in order to calculate the maximum price that they can afford. So in particular, we think about a rise in the maximum loan-to-value constraint from 90% to 95% of purchase price, and we think about the 20% equity loan that applied specifically to new builds. And then finally, with these maximum affordable house prices, we find this on their local house price distributions, which gives us the share of properties affordable in their local area before and after the relaxation of borrowing constraints. And I'll just quickly show you kind of that our results are capturing something that is economically meaningful before I go on to showing you some results from this exercise. So a key question is, okay, is the affordability measure that we come up with actually telling you something that's kind of meaningful and relevant about who's able to buy a house? And to test this, we use our pre-policy sample, and we split people into tenths by the share of properties in their local area that we estimate that they're able to afford. These are all people who don't own their own home, but because we have panel data, we're able to see who buys a house in the next couple of years. And when we look at the shares of people who do buy a house in the next couple of years by this decile of pre-policy affordability, we see that our affordability is capturing something that's meaningful. People for whom a larger share of properties are affordable are moving into home ownership at much higher rates. Okay, so much for the method that we use. Now I'll go on to show you some results. And I'll start with a couple of slides thinking about the overall impact on affordability before I go into kind of the results that we have for different groups. To start off with, I'll show you the distribution of the maximum affordable house price under these different borrowing constraints. First of all, here's the distribution of the maximum affordable house price for people who don't own their homes pre-Help to Buy. Here, I'm showing you the difference that the mortgage guarantee scheme makes to the distribution of the maximum affordable house price. And something you'll note here is that this looks very similar to what we see for the pre-Help to Buy distribution. And the reason that we're finding this is that we find that many more people in our sample are constrained by the incomes that they have rather than the maximum deposit that they can feasibly put down. Because the mortgage guarantee scheme is only reducing the deposit that you have to put down as a share of house prices, it's not increasing the amount that you're able to borrow. We find it's not having a massive impact on affording the price and increasing the price that's affordable for most individuals. In contrast, when we look at the distribution of the maximum price affordable under the equity loan scheme, we see that there is here quite a big difference. The distribution is shifting to the right. The maximum house price that most people can afford is going up. We can think then about what that looks like in terms of the share of local properties affordable. Here I'm showing you the distribution of the share of local properties affordable before the Help to Buy scheme, and here I'm showing you what that looks like after the Help to Buy scheme. You'll see that the distribution is shifting to the right. More local properties are affordable after the relaxation of borrowing constraints. Something else to note here is that this is a relatively muted shift. You'll recall that the equity loan scheme only applied to new builds. So even if we see quite a substantial shift in the price you can pay for a new build, if new builds are only a very small share of the houses actually available to you in your local area, that's still going to make a relatively minor difference to what share of properties are actually affordable to you. So there are two kind of stylized facts about the effects of these Help to Buy schemes, and I'll now tell you a bit about how these effects differed by different groups, which is a kind of key advantage of our approach and of the detailed survey data that we can use. I'll start off by showing you some results by income group. So we'll first think about how the maximum affordable house price changed for people in different income groups. I'm showing you here the maximum affordable house price by people in different income quintiles. I first show the difference that the mortgage guarantee scheme makes. So this is the first set of green bars on the chart. And you can see that as we saw for the overall graph, the mortgage guarantee scheme is making very little difference to the maximum price affordable, perhaps slightly more in the very top income group. We can see that the equity loan scheme is making much more of a difference to the maximum price affordable, and it's particularly pushing prices up for those in the highest income group. Thinking about how this translates into the share of properties affordable, you can see that higher income people, as we might expect, are able to afford lots more houses in their local area. And as you can see, the gains as a result of the relaxation of borrowing constraints are also larger for this higher income group. Thinking now about how this differs by region and our results by region more broadly, and here there's quite a nuanced story. So here I'm showing you our estimated maximum affordable house price by region pre-Help to Buy. Again, mortgage guarantee scheme making very little difference. And the equity loan scheme, as we've seen, makes more difference. And this is particularly the case in these higher priced areas, so London and the southeast. And we see a similar sort of pattern to what we saw from region. So those people who could already afford a higher house price are also having their kind of maximum price pushed up by more. But when we think about how that translates into the share of properties affordable, here I'm showing you what that looks like pre-Help to Buy. And as you can see, those who live in these more expensive areas, despite the fact that they can afford to pay a higher price for their houses, can actually afford a lower share of properties in their local area, driven by the different housing characteristics, particularly the higher prices in their areas. And thinking about the affordability gains under these policies, we can see that these are in fact lower in higher price areas like London and the southeast, compared to those who live in cheaper areas. And thinking finally about what this looks like by some kind of broad measures of parental background. I'm first of all showing you some very similar graphs, so both for maximum price affordable and for the share of local properties affordable. We broadly split people into two kind of quite broad groups, those whose parents didn't and did have a degree when they were a child, and those whose parents worked a mid or high skill job versus having no job or a low skill job. When we look at the maximum house price affordable, what you can see from this is that pre-Help to Buy, those with better off parents measured using these kind of very broad metrics could afford more in terms of the maximum house price, but the size of the gains under the mortgage guarantee and equity loan schemes look quite similar. When we think about the change to the share of properties affordable, it looks like there's actually very little difference by parental background. So it doesn't look like the relaxation of borrowing constraints is having a dramatically dramatically differing for people based on their parental background. It's neither kind of widening nor narrowing gaps in affordability. So with each of these kinds of differences by income, by region, or parental status, there are clearly a lot of different factors going on, all influencing affordability. So for example, higher income people might have higher deposit capacity, but they might tend to live in higher price areas where the share of new builds might be lower, muting affordability gains. And we want to understand kind of which factors are most important in driving the variation across people and kind of affordability that we see. And to understand which factors are the most important, we can kind of broadly decompose variation in affordability into three channels. First of all, there's income, which, as we've seen for most people, determines the size of the mortgage they can afford. Second, there's the role that local housing characteristics plays, or broadly geography plays, so in terms of the prices that people face and in terms of the share of new builds in someone's local area. And then finally, there's people's estimated maximum deposit capacity. And we can hold two of these channels fixed at one time and only vary one, and look at how much variation we see across people in terms of the share of houses that they can afford in their local area, to understand how much each of these three channels is contributing to variation in affordability across non-homeowners. And to finish off, I'll show you results from this exercise. First of all, thinking about affordability levels before Help to Buy. So here I'm showing you the share of the total variance that each channel can account for. And the thing to take away from this is that area is the most important factor in terms of determining pre-policy affordability. So variation in affordability between people driven by the area in which they live can account for more than 80% of the total variance. Income is also very important. When it comes to affordability gains, we can see that income looks like the most important factor in explaining the variation across different people in the gains that they get from Help to Buy. So think about the graph I showed with higher income people having affordability gains concentrated from these schemes. We can see that very little or relatively little of the variation is explained by differences in people's deposit capacity. So to wind up, I'll kind of summarize and then put a couple of reflections down. We've proposed this new approach to evaluating housing affordability and then applied this to the Help to Buy policies introduced in England in 2013. This research kind of suggests that income-based constraints rather than deposit-based constraints seem to have been more binding in this period, so in the early 2010s. And we find that affordability gains from the relaxation of borrowing constraints were concentrated among those people who are higher income and don't seem to have significantly differed by parental backgrounds. We find that those in London and in the southeast saw larger increases in the maximum price that they could afford to pay for a property, but in fact saw smaller increases in the share of local properties affordable compared to those living in cheaper areas. And one important caveat that I'll also mention in the next slide is that we don't here account for effects of these schemes on kind of prices or housing supply. To the extent that these schemes push prices up, this will undermine the overall affordability gains, but the distributional story here is really important. And some kind of broad implications are, first of all, that income constraints are likely to have been more important than is often assumed. And we think this means that schemes that only relax deposit constraints may be unlikely to have significant effects on overall home ownership rates or the shares of properties available to people. It's also true that to the extent these demand-side schemes don't increase the overall supply of houses for sale, their main effect will be distributional, and they're likely to increase prices. These sorts of schemes also often increase the government increasing its exposure to housing market downturns, and for this reason there are clear trade-offs if considering introducing or expanding these sorts of schemes. That's all from me, and now I'll pass on to Ken, I think, to respond.
Thanks, B. Ken, oh, there we go, appeared magically on the screen. We can see now. Ken, do respond.
Yeah, thanks. I hope you can all hear me okay. So yeah, thanks for letting me be here today. I'm really grateful for the opportunity to talk to you. I've been part of the advisory group of the Homes England funded research, so I've been able to kind of watch this project evolve over the last wee while. So that's been really very worthwhile for me. I should also say, in your wider context of affordability, I've been for the last 3 years, the chair of a working group that the Scottish Government has, which is described as trying to get towards a shared understanding of housing affordability. And we've had hard hats and painkillers since we started that work. It's, as you can imagine, highly contested. And I'm sure in the course of today, you're going to hear some debates about what affordability means in a broader sense. We've obviously just gone through a specific way of thinking about it, which I'll come back to. So this project, more broadly, is about faltering access to home ownership and how it can reduce social mobility, but also increase wealth inequalities, which seem to be an incredibly important set of issues. And I think the interaction of affordability with the Help to Buy type of demand-side policy is something that's both instructive for us, but also very thought-provoking, and that's what I'm going to try and engage with in the next few minutes. So I took away a few points from the presentation and the associated papers. I think it's really important to think about the heterogeneity and consequently the distributional profile of different households seeking to become homeowners and how they are affected by the Help to Buy intervention. Secondly, I think the idea that income constraints dominate deposit constraints is a really important one, and of course, at one level, as was said in the very introduction this morning, if median house price to income ratios are approaching 8, then income constraints are really essential. And in our work in affordability in Scotland, we've stressed the fact that income levels, benefit levels, minimum wage levels, all of these things are incredibly important to the trajectory of rental affordability in our case. So I absolutely on line with that. I do think, however, that in a sense, this really interesting way of thinking about affordability for home ownership is what I would call fundamentally about access affordability, and that's absolutely right. It's about access to home ownership, but clearly that's only a subset of affordability issues. There's also sustaining home ownership as well, and its importance in a number of respects, and that's only part of the many philosophical and empirical difficulties that you get into with affordability very quickly. The next thing I wanted to suggest, I suppose, is that this is easily readily framed as a kind of part of an evaluation of help to buy. And that's quite understandable, although clearly it speaks to a very specific time period at the beginning of the Help to Buy intervention. But it does seem to me that the usefulness of this kind of distributional heterogeneity-based way of thinking about affordability is a really important element in any current or future attempt to assess these sorts of interventions. So I do agree that there's a wider role and space for this kind of way of thinking about using the data, the panel data that one has to really do much more sophisticated distributional work. So I want to move on now to a few kind of reflections on modelling, but also going a bit beyond that as well, if I may, and actually raise some of these issues as she went along, so I won't spend a huge amount of time on them. I'm really interested in the drivers of deposits and what sort of things explain the maximum deposits people can have and how we model that. And I was really interested to hear the expansion of the kind of sample selection issues, given that there are these issues about unobserved characteristics and also other sample selection things that make it at least challenging to use people who have become homeowners as the kind of the basis for the parameters to think about similar people who are not currently homeowners. So I think that's very important. It'd be really interesting to think about further work in that area, because beyond this specific case about help to buy, I think there's something really interesting and important about how we understand what's important with deposits, even if income constraints are the big driver that we're getting at. Second thing, and you won't be surprised to hear me say this, I was pleased to pick up on the importance of the potential house price effects that Help to Buy is often suggested to have, and indeed in the papers that are associated with today, I know that you've reflected on the fact that particularly in supply constrained areas, you'd expect to see house price effects, which is very much where previous research has gone. And it made me wonder if future work, if you were to take the kind of time periods of the panel forward, if there would be utility in trying to measure at a local micro scale in different market contexts the kinds of typical house price effects that independently were arriving from Help to Buy, and you could then perhaps use some of the learning from that within the kind of modelling that's going on. Beyond the modelling, a couple of rather grandiosely called philosophical questions. The first of these is, as is mentioned in the paper and in a lot of the literature, it seems from the evidence and evaluations that what Help to Buy often does is it accelerates the choice of becoming a home owner. And I think for me, there's a question about at what point does the accelerated choice of becoming a homeowner stop becoming an additional element of a Help to Buy policy? And I think that's something that we should have a think about. I can see that if people are able to bring forward purchase by say 5 years, that feels like a substantial difference in people's lives. But if you're talking about 6 months, 12 months, 18 months, it feels more it's part of a wider sort of choice set. So again, that relates to the kinds of deposits people can have, the speed of their saving, and particularly their access to external funds, as B said. The second thing I would raise, and you know, in a sense, B made this point very clearly, that your focus today is on first-time buyers. But one of the strange things about Help to Buy, it seems to me, is both in England but across the UK as well, there's always been an existing owners element to Help to Buy. And that just, at one level, seems like an odd thing to do in terms of value for money and cost benefit. It just seems an odd thing to have them in there as well, who are clearly in a very different market context and a wealth context. Finally, B asked me in the run up to this if I would say something about what's happening in Scotland, because we actually have a bit of action going on in the policy space about these sorts of policies right now. So we previously had Help to Buy. We also had something called the First Homes Fund, which was an initiative which provided interest-free equity loans of up to £25,000 to first-time buyers only, but with no caps on prices, no limits in that sense, just that they had to be first-time buyers, and that the maximum award of the equity loan was £25,000. That ended in 2020, but was very popular. It was popular with households. It had high take-up rates. It was also very popular with the development sector and other people, and there's been a lot of calls for it to come back. And actually, just about 3 weeks ago, the First Minister said that if the SNP are re-elected next month, that they will reintroduce the First Homes Fund, but it will be for a smaller amount. It will be for up to £10,000 equity shares only. Obviously, our house prices are lower, but they are still very high relative to incomes than they are, say, in England. But this scheme is something that's seen as a way of boosting first-time buyers, and it will be targeted again at first-time buyers only, but there'll be no cap on prices either. So there's a better than evens chance that we are going to have such a scheme coming in the near future. So I just wanted to make that point, because this is a real live policy space in Scotland. It looks like it's going to happen. I know there's some discussion going on around whether the government in England may also be interested in returning to something like that, but we'll have to wait and see about that. But I'll stop at that point. Let me just finish by saying I've really enjoyed the research and the paper, and I enjoyed the presentation as well this morning, so thanks.
Thank you very much, Ken. So now we have about 20 minutes for Q&A. If you're online, do remember to be popping your questions into the Slido app. If you're in person, just should be reminding you to please hold the microphones up to your mouth so that the people online can also hear your questions, and do introduce yourself by saying your name and institution beforehand. Just quickly, though, I'm going to abuse my sort of place as the chair of this session to sort of ask a question or two of my own. I think, firstly, just sort of stepping back, your sort of work showed that this equity loan scheme had, a much larger effect on affordability than the mortgage guarantee scheme, but particularly for those with higher incomes, who maybe not the government, the groups that the government might be wishing to target. Depends on what exactly their aims are. But are there any lessons that you would take for the design of demand-side policies from this work? And Ken, if you've got any thoughts on that as well, on which things might work particularly well and how to potentially target them?
Yeah, I think that these schemes clearly come with trade-offs. I think, as I kind of said in the presentation, there's a risk that these sorts of schemes do push overall prices up to the extent that they don't just increase the supply of houses for sale. And indeed, kind of other work on these schemes finds that the equity loan scheme did have an effect on housing prices. And they also do clearly kind of increase the exposure of people to risks in housing market downturns. That's both the government and also people kind of enabled to buy a house using these schemes. So there are kind of really clear risks here. And I think that, one important point, if the government does want to kind of target lower income non-homeowners, for example, is that these risks are likely to be greater if people are kind of borrowing a higher multiple of their income, for example. I think the general question of who the government should be targeting is a kind of policy question, but we're able to kind of say quite a lot using this metric on who seems actually to be helped using their individual characteristics. I don't know if Ken wants to say anything on that.
Yeah, I guess it comes back a little bit to my earlier comment about the sort of affordability of sustaining a mortgage as well as the affordability of access. That I absolutely agree with that these trade-offs are all there, and that additional risk must be part and parcel of expanding home ownership. But it always is. It just as you deregulate, in a different policy space, that's the trade-off that's being made. That if you're bringing more people in at the bottom end of the market, in some respects, you're going to increase that risk and that exposure. And I think it also, therefore, makes us think a little bit about how far policy goes to support people once they are a mortgager. Because currently, at the moment, obviously policy has greatly retreated in that area over the last 20 years. So are there things that can be done to basically manage arrears and defaults and prevent that happening in the first place? Are there things that can be tailored and worked through that way? So there's a consequence of sustaining home ownership policies that have to flow from expanding access at the margin, it seems to me.
Yeah, thanks, Ken. That actually relates to a question on Slido, which asks if there's any evidence that potentially from Scotland or from elsewhere that you may have been involved in, on how these sort of schemes for first-time buyers affect this sort of long-term measure of affordability. Is there any evidence on this in the literature?
Well, my first point as a get out is that this big affordability piece of work we did is about rental affordability rather than home ownership. But yes, I mean, I think there certainly are evaluations, and we've already alluded to some of the evaluations that the government has funded, as well as private academic work that's been done in the area in England, and certainly in Scotland. There's been quite a bit of work done, which generally it's something that recognises it's quite difficult to isolate these effects. It's quite difficult to work out price effects, and often the evaluation studies aren't really in a position to go into the depth and be focused in the way that the IFS work has been. But certainly there are reasonable levels of additionality associated with them. But what it's much harder to tell is these issues about how seriously do we take the accelerating of someone's choice to become a homeowner when perhaps they might have been able to do that in any case? Is it a choice thing that they could have done anyway, or have they genuinely had their position improved? And I can think of two sets of evaluations in Scotland recently which struggle with that because they don't really have the data to even the survey evidence they've got. They can't really break that down.
Okay, great. I think we'll take some questions from the room now. I think the man with the glasses who had his hand up first. Yes, just in front of you there. Yeah.
Thanks very much. Fascinating, really interesting. I've got a couple of questions. They're interrelated. Many of the house builders, especially in the currently volatile market, house builders, especially in London, the South East, are crying out for demand-side stimulus. So a potential reintroduction of something akin to Help to Buy might be the answer. Does the panel online as well agree? Point number two, do you think a next phase of this research should also include a affordability comparison with shared ownership and discounted market sale schemes? Point number three, are there any discernible observations regarding the differences between affordability, both regionally but also by typology. And what I mean by typology, the difference between houses and flats.
Great. Several questions there to get your teeth into.
Yeah, I mean, on the first, in terms of house builders wanting another Help to Buy scheme, I think that there is, there's some evidence showing that these schemes do have some impact on housing supply. That was clearly the intention of the first equity loan scheme. And, all else equal, we would expect there to be some impact on the supply of new builds from a policy subsidising new builds. That said, kind of housing supply in England is relatively constrained, we know from other evidence, and so it's likely that these schemes, as I kind of said, will also push prices up and clearly increase risks. So there are obvious trade-offs here, and I think from a house builder's perspective, clearly it's particularly desirable to have the purchase of new builds subsidised from that perspective. That's of course just one perspective on the various kind of issues and trade-offs associated with these policies. I think on the other questions, I think, definitely some sort of evaluation of schemes like shared ownership would be really interesting. It's not something that we could kind of directly speak to in our work, but I think the sorts of evaluations or measures of affordability that we create could in theory be used to evaluate these sorts of schemes, and it's definitely something, we might be interested at looking at in the future. I think also the panel later today will speak to the impact of these sorts of kind of other schemes to think about housing affordability, things like shared ownership. So hopefully we'll see a bit more discussion of that later today. I think the same is kind of broadly true for typologies. The difference between houses and flats is something we would really like to look into and didn't kind of get into in this work, but it's for sure an interesting question. I think it's likely that there are some quite different impacts, perhaps particularly with kind of a quite binding price cap on the properties that can be afforded. And I think, one key question when thinking about housing affordability is really, are you making more houses affordable, but also are you making kind of the sorts of houses that people want to live in affordable? If you're a family and you have more one-bed flats that are affordable to you, does that actually kind of meaningfully change your opportunities? So that is for sure, I think, one way in which you can dig a bit more into this question and something we'd like to think more about.
Ken, do you have anything to add?
I definitely want to consider focusing on first-time buyers, I think, and also to think about caps in a more caps to prices in a more thoughtful way. I guess. Secondly, I think absolutely we've done well, not me personally, but I know colleagues like Glenn Bramley have done broader assessments of the whole gamut of these sorts of policies, from shared ownership, equity loans, help to buy, etc. And that just seems to make a lot of sense, to get a comparative sense of what works and what doesn't. And also, I think in regard to the property types and those sorts of issues, it does seem to me there's a place-based sense in which assessment of these things would be useful. So, in some areas it's also about density as well, isn't it? I mean, there's a lot of interest at the moment in more medium density house building in urban areas, for instance, which presupposes flats. But getting a sense of what these wider benefits are, that the evaluation is not simply about additionality and deadweight and value for money. It's also about a whole set of broader social and economic impacts, and that would include the better use of brownfield sites and things like that, it seems to me, which could be quite important.
Thank you. Next question, I guess the man with the sort of case just next to you, Greg.
Morning, thank you. Michael Percy, I'm director of a charity that deals with community and health and wellbeing services in London. I must admit I'm a natural cynic of Help to Buy, regarding it as being help to sell at a higher price, which I think our first questioner indicated that's what developers want. I wonder whether there's been any research on resale prices as to whether, when people who've bought on Help to Buy paid a higher price, which we recognise is definitely there, when they've come to sell, particularly, and I think there's been probably a pressure to sell after 5 years when the guarantee becomes chargeable to interest, whether the gain which might have been expected has all been absorbed in the higher price paid to the original, paid by the original buyer.
It's a good question. I'm not directly aware of research on that, but I think I can see the mechanism that you're talking about in terms of these schemes pushing prices up. I'm not sure I'd say it was the key question. I think an important question is whether people are able to buy a house for the first time. If people aren't planning to sell after 5 years, it doesn't really matter what's happening to the price of their home in that 5-year period. So I think that, there are many aspects to housing affordability and to people's kind of broader economic well-being and their wealth. It matters to some extent what's happening to their house prices in a 5-year period, but if someone is looking to buy a house that they then plan to live in for a much longer period of time, it's perhaps less important the price effects are in that kind of 5-year period.
There's a question down here at the front.
Thank you. I'll start by introducing I'm from Homes England, so I'm responsible for the operational delivery of Help to Buy and our legacy equity loans, which includes First Time Buyers Initiative and Home Buy Direct. We still have those customers. So thank you for the presentation. You referred to the 20% equity loan in that presentation. How did your research incorporate the 40% equity loan in the London area and also the regional price caps when it comes to affordability as well?
It's a really good question. I'll say briefly, we're thinking about the schemes kind of as they were introduced in their first iteration, so in 2013. So we're really thinking about just the 20% equity loan across the country, as was the case for the first iteration of the schemes. I think that our method could quite easily allow different kind of versions, so using the regional price caps, using the 40% equity loan in London to be incorporated. I think I'd expect the 40% equity loan probably to have more of an effect on the kind of results than these regional price caps, just because at least in the period we're thinking about, the price caps were fairly high. But it's, we could definitely look into that, and I think that would be relatively easy using our measures of affordability.
While we're talking about sort of methodology, there's a question on Slido, which is asking if you could discuss the benefits of your new affordability measure, which was based on observing people's sort of previous people's actual transitions into home ownership and thinking about whether people you observe are going to do those transitions as well, relative to others, which I think you said have focused more on observing people's liquid savings and thinking about whether they have enough for a deposit.
So I think there are kind of clearly quite a lot of definitions of housing affordability floating around. And I think most of these are kind of pretty helpful in telling you about some aspects of affordability. So in some ways, I think our measure is an improvement on some methods, but also a kind of complement for other methods of affordability. We think that using people's actual deposits to estimate deposit capacity is giving you kind of a better measure of what other people might be able to put down. We've previously done work at the IFS kind of using people's observed liquid savings or total savings to estimate their deposit capacity. And I think this tells you about kind of what people might be able to put down at one point in time if you catch them right now and they're not allowed to kind of have any other sort of help, which is an interesting question. But we know that, for example, parental transfers to help with deposits are becoming increasingly important over time. We think that in at least some survey data, kind of liquid savings might be underreported. And in this previous work that we've done, at least, looking into kind of liquid savings as a measure of deposit capacity, something that came out of that is that for a lot of people who we see between two waves of our survey, we see their liquid savings, then we see kind of the deposit that they go on to put down in the next wave. For kind of most of them, we don't find that they actually seem to have been able to afford the deposit that we see them put down at all, even kind of making reasonable adjustments to their savings that we see in the previous wave. So we think that using people's actual deposits in this way kind of is helping us get closer to a realistic measure of what might be available to most people in terms of broader resources. And I think this is also kind of a nice complement to traditional measures like house price to income ratios, for example. These clearly tell you something important about how house prices are evolving in relation to kind of people's resources, thinking about how the house price to income ratios are changing. But that measure doesn't, for example, tell you anything about how much people are able to borrow. So, for example, when thinking about these Help to Buy schemes and the way in which they change what people are able to actually borrow, looking at how the house price to income ratio changed wouldn't actually tell you that people are now able to borrow, say, not people are able to borrow more, but the mortgage that people have to take out to buy a house is decreasing, or the deposit that people have to put down is falling.
Yeah, that makes a lot of sense. Should take some more questions. There's a question here near the front.
Thank you, Chair. Donald Roy, without any affiliation. Two questions. The first one has to do with the income to housing price data. I was a little surprised to see the suggestion that the doubling had occurred, that the increase had occurred over half a century. My impression, and please let me know if I'm wrong, is that between the 70s and well into the 90s, the ratio was in fact stable, and the big increase has gone on from the middle 90s onwards. So that's my first one. The other one is, it seems interesting that one particular niche group that has been identified in the Financial Times, the Henrys, high earnings, not rich yet, appear to have been the principal beneficiaries of the scheme. It'd be interesting to know whether this represented anybody's actual policy choice.
Good questions. In terms of the increase in the price to income ratio that you talk about, I think you are right that the bulk of this increase is really happening from the mid-90s onwards. You're right to point that out as kind of a rough stylized fact to use. In terms of the highest earning people being beneficiaries of this scheme, I think that's true. And indeed, when we looked at the kind of income quintiles, we saw that the kind of highest income group defined there were benefiting a little in terms of an increase in affordability from the mortgage guarantee scheme. And I expect that conclusion might increase if you used more granular income groups and looked just at the very highest earners. So those people on very high incomes, perhaps with very minimal deposit capacity, are the ones who might be helped by both the mortgage guarantee as well as the equity loan scheme.
Do we want to wait for a microphone?
There was an external factor there. The change in the remit of the Bank of England almost certainly had a very significant effect on lending policy and on the ratio.
That could very well be true. I think we talk about, the importance of lending policy and of borrowing constraints through this work.
Thanks. I think not got much time left, but there's a question towards the back, if you could.
Hiya, Connor from the Intergenerational Foundation. I have a question on whether you thought about how private rents affected affordability, and I suppose more specifically, were you able to look at differences in current tenure between prospective buyers? So thinking about the differences between those perhaps who are paying in the private rental sector versus those who move back in with their parents, because certainly amongst that latter group, which seems to be increasing, you would think that would increase their maximum deposit capacity. So yeah, did you get a sense in differences in tenure between prospective buyers?
Yeah, so the sample we're looking at is kind of every young person that doesn't currently own the house they're living in. So we should include people kind of living in social housing and private rented housing, and also who live with their parents. So we could, in theory, look at differences in capacity with this group, although that's not something that we explicitly did in the paper. I think it's definitely true that we see over time an increase in the share of young people who are still living with their parents as young adults, and that is likely to have important effects on saving. We kind of looked at this group in previous work at IFS, and we found that at least for some parts of this group, there did seem to be an increase in the savings that they were able to make, although it's worth noting that for others who perhaps moved back home after kind of negative events, maybe unemployment, for example, they didn't seem to be adding to their savings in the same way. But I think it's definitely true that those living with their parents are likely to be able, in theory, to make larger savings as a result of avoiding paying private rents. And that is likely to be kind of increasingly important, really, when we think about these questions of housing affordability.
Great, thank you very much. So we're pretty much at 10, and I don't think I see many other questions in the room. So I think we can call this session to an end. Thanks very much to Bea and to Ken for speaking, and also for all your questions in the room. We now have tea and coffee in the room just over there, and we'll reconvene here at 20 past for the next session. Thank you very much.
Okay, hello everyone, and welcome back. For those I didn't meet this morning, I'm Helen Miller, I'm Director of the IFS. Thank you everyone for being here in London. Thank you to all of those who are joining online. We now have a keynote, which I'm very pleased about. So I'm very pleased to be introducing Christian Hilber, who is Professor of Economic Geography and the Deputy Head of the Department at the Department of Geography and Environment at the LSE. He has lots of other affiliations that I won't all read out, but including as an Associate of the Centre for Economic Performance at the LSE. And Christian's going to tell us why UK housing is so expensive. We'll then have time for some of your questions. So again, if you're in the room, there'll be a roving microphone. And if you're online, you can pop them on Slido and we'll get them to Christian. But for now, the floor is yours. Thank you, Christian.
Okay, thank you very much for the invitation. Thank you very much for the kind introduction. I'm very pleased to be here and to answer the question, why is housing in the UK so expensive and what can be done about it? And allow me to start this lecture with a tale of two countries. The two countries I'm talking about are the UK, the main focus of this lecture. The other country is my native country, Switzerland. Those are two countries with, at least historically, very different institutions, very different institutional settings, and very different housing policies and problems. Let me start with the UK. The perceived problem in the UK is what we have been already talking about this morning, housing affordability. It hasn't been a problem just since a couple of years. It has been a problem since several decades. I moved here in 2003 and it was already a big problem back then. This protester summarizes it quite succinctly. I work full time, yet I cannot afford rent. The Financial Times argued that the housing crisis is at the very center of Britain's ills. And it reports that Britain has the highest rate of homelessness in the developed world. If you ask Londoners what are the main issues facing the capital, the top 5 issues are, the number 1 issue is the cost of living. And of course, housing is a major part of the cost of living. The number 2 issue that is mentioned is actually housing affordability. And homelessness and rough sleeping is also on this list of top 5 issues. It's a major issue in this city. 97% of the MPs and 72% of the public agree that the country is in a housing crisis. Now, if we switch a couple of 100 kilometers to the south and we go to Switzerland, at least until the 2010s, there has been a very different perceived problem when it comes to housing markets. The perceived problem is urban sprawl. So this picture with the Matterhorn summarizes it quite succinctly. What the fear is in Switzerland, the fear is that we concrete up our mountains, we concrete up the Matterhorn. And this journalist in a well-known Swiss newspaper wrote, in this village, everybody can build whenever they want and wherever they want. So, as you know, in Switzerland, we like to vote. We vote a lot. And so, given that we have initiatives and referenda, in 2012, an initiative came up to ban second homes, the so-called second home initiative. This initiative was very narrowly approved by the public with 50.6%, and what it did is it banned the construction of any new second homes in touristy areas with more than 20% second homes. But it didn't stop there. In 2013, Switzerland voted again, and this time it approved the initiative, or the referendum more clearly. This was about a revision of the Swiss Spatial Planning Act. It's kind of akin to the Town and Country Planning Act. And this time it approved it much more clearly. The main purpose of this reform is to contain urban sprawl. So you see two countries, two very different problems. So why are these perceived problems so different? I think this slide here gives an answer. If we look at real house price, this is not nominal house price growth, this is real house price growth adjusted for the CPI, like using data from the BIS. If you look at real house price growth over the past 55 years, house prices in real terms increased by slightly over 100% in Switzerland. And this is despite very strong population growth in the country and also quite strong real economic growth as well. If we compare this to the UK, real house prices increased by nearly 400%, so almost 4 times as much as in Switzerland. And of course, if we look at London, London is off the charts. So if we put this into an international comparison, Switzerland is towards the bottom end of the table. It's not actually the country with the lowest house price growth. For example, Germany or Japan have lower house price growth compared to Switzerland. But if you look at the top end of this league table, I'm not sure you want to be on the top end of the league table, then the UK is second, just very narrowly behind New Zealand. Which is interesting because New Zealand has many more sheep than it has people. What is also interesting is if you look at the 4 countries with the highest real house price growth amongst developing countries in over the past 55 years, it's Canada, Australia, United Kingdom, and New Zealand. What do these 4 countries have in common? Yes, they are all Commonwealth countries, and actually Canada, Australia, and New Zealand copied elements of the British planning system. So I think this tells you where I might be going with this talk. So if we look at housing affordability today, so there are many ways to measure housing affordability. So what I did here is I tried to find data in Switzerland and the UK that are, or Switzerland and England actually, that are comparable. So what I did is I calculated the average private rent relative to the average or median gross income. And a rough rule of thumb is you shouldn't spend more than 30% of your income on housing, or you shouldn't spend more than a third. So if we take this 30% ratio, Switzerland is actually, perhaps to the surprise of some in this room, in the affordable range. On average, in Switzerland, the median earner spends roughly 20% on a private rent, on the average private flat. Zurich is more expensive, and so if you have ever been in Zurich or you have ever lived in Zurich, you might think, well, but rents and prices are really expensive in Zurich. Yes, they are, but incomes are very high as well. So in relative terms, actually, housing is still relative, or has been until very, very recently, has been quite affordable. So below this 30% affordability threshold. If we look at England, it's very different. So even on average, we are significantly over this 30% range. And again, London is off the chart. So this price, average private rent to gross income ratio is over 50% in London. And I think this explains why so many young people in this city stay with their parents for much longer than they wished. They cannot afford to live on their own. And it also explains why we have so many homeless people in this city, but also in this country. So another statistic to look at is housing construction. And I know there is some debate about how exactly to measure housing construction, etc. But the big picture is very clear. We build roughly half as many housing units today than we built back in 1970. And in the late 1960s, we built even more housing units. And if you compare this to Switzerland, Switzerland builds around 3 times as many housing units per capita compared to the UK. And not only does it build 3 times, or at least until the 2010s, it has built 3 times as many housing units. The housing units are a bit bigger on average, and may I say they are also higher quality. So how can we explain these stark differences? And the proposition that I want to put to you is, well, it has to do with the institutional setting. In the UK, we have a very restrictive land use planning system, and the whole country is quite centralized, and the tax system is also centralized. In Switzerland, on the other hand, the planning system is quite flexible, and the tax system and generally the system is decentralized. So let me dig down a little bit deeper. Let's first focus on the UK. So I already mentioned the UK as an extremely restrictive land use planning system. The main aim of this system is development control. The system is idiosyncratic. If you apply for permission to build something, every single change of land use requires a permission. This is different from most other countries in the world where we have zoning systems or master plan systems which are rule-based. Another feature of this system is that it caters to NIMBY home voters, homeowners who vote to protect their interests. The planning system constrains supply in all directions. We can't build outwards in this country because all the major cities are surrounded by green belts. That alone wouldn't be so much of a problem, because there are other countries where you can't build outwards because they're surrounded by water or by other constraints. So what other cities do is they grow upwards. But the British planning system largely prevents that as well. There are height restrictions everywhere. There are view corridors everywhere that prevent building upwards in many places. And lastly, if you look at central cities, actually it's very difficult to knock down buildings and renew, like build at higher density and build more sustainably, because large parts of central cities are protected. 70% of central London is conservation areas or listed buildings. But it's not just the planning system, it's also the tax system, and in fact how these two, the planning system and the tax system, work together. In England or in the UK, councils have no fiscal incentives to permit development. Why is that? Because councils face most of the costs of developing, so they have the infrastructure costs, they have to provide local public schools, they have a political cost in that they are elected by the NIMBY residents who don't like building in their neighborhoods. So they have all of these costs, but they reap very few of the benefits if they permit development. The only major fiscal benefit that local councils get is the council tax. But it's not a very important tax. Moreover, in the medium term or longer term, any additional council tax revenue that you generate through permitting development is redistributed away again through the central government grant system. So this really means we have a double whammy for housing affordability. Now contrast this to the institutional setting of Switzerland. Switzerland has a flexible rule-based zoning system comparable to other countries like Germany. Until the mid-2010s, local municipalities had complete autonomy to zone residential land. So they could essentially do whatever they wanted. They could zone as much residential land as they wanted. This is where the tax system comes into play. Municipalities have very strong fiscal incentives in Switzerland to zone land for residential purposes. Or in other words, the benefits of attracting a taxpayer into your municipality are greater than the cost. Municipalities in Switzerland can keep the local income tax revenue, and they compete for taxpayers. They try to attract the best taxpayers. Like there was a time when Federer was looking for a new home in Switzerland, and every municipality in the canton of Zurich at the lake, near the lake where he wanted to live, tried to attract him. So municipalities in Switzerland have very strong fiscal incentives to zone large parts, not at the center of towns, because we have NIMBYs there as well, but at the outskirts of the municipalities. And that's exactly what leads to sprawl. So you see, the planning system in combination with the tax system can explain much of what's going on here. So housing in Switzerland has been quite affordable until the 2010s at least, but at the cost of sprawl. So what does the more rigorous empirical evidence tell us? I did a paper with Wouter van Meulen in 2016 where we looked at the role of these supply constraints for house prices in England. And we asked the question, what would house prices be in an average English local authority? And our regression analysis suggests that if we were to remove all regulatory supply constraints, house prices would be about 35% lower. And as my colleague Paul Cheshire will point out, this is very likely an underestimate of the true effect. But of course, we don't want to get rid of all the land use planning. There are reasons for land use planning. There is an economic rationale, in fact, for land use planning. The rationale is to correct market failures. So in another exercise, we asked the question, well, what would house prices be in the most restrictive region in England, which happens to be the Southeast, not London, if it had the regulatory restrictiveness of the least restrictive region. The least restrictive region in this country is the Northeast. It's the least restrictive region in this country. It's still very restrictive in an international context. And the answer is, if the Southeast had the restrictiveness of the Northeast, house prices would still be 25% lower. Again, this is, for reasons I'm not going to go into because of time, this is likely an underestimate. So the impact of the land use planning system is very substantial. So what about the role of fiscal incentives? What Paul Cheshire and I have done in another study, also published in the EJ, is we asked the question, what is the impact of reform in 1990 that nationalized the commercial property tax, the so-called business rate? So what happened in 1990 is, until 1989, the tax revenue from the business rate went to the local authorities from 1990 onwards. It was nationalized. So effectively, the reform removed fiscal incentives at the local level to permit commercial development. So what are the key findings of this work? The first one is we estimated the so-called regulatory tax, like a markup over construction costs. And what we find is that this regulatory tax is the highest, for office markets, is the highest in Europe. In London West End, the regulatory tax exceeds 8 times the marginal construction costs. The second key finding is that the reformed induced increase in the regulatory tax significantly exceeded the revenue generated, the entire revenue generated by this property tax. So, suggesting that fiscal incentives are powerful. So, let me conclude with what we should be doing. So, what should we not do? I think we shouldn't subsidize demand in supply inelastic areas, but that wasn't my task. My task was to talk about what to do. So, well, it's a very tough job to solve this crisis. But if we really want to solve this affordability crisis, I think we shouldn't be dealing with the symptoms of the crisis. We need to tackle the actual root causes of the problem. So what does this mean? It first means we ought to reform the planning system. So what we could do, I know this is hard, and that's probably why many successive governments shied away from this. We should consider moving, or at least experimenting, with a rules-based zoning system. So we could introduce this in parts of a country and experiment with it and see how it works. We arguably should remove uncertainties created by the planning system. An example is the uncertainties created by Section 106 agreement. This creates huge uncertainties to the developers and leads to less construction as a consequence. We arguably should also assess each regulation based not just on the total benefits it creates, planners do that, but we should also look at the costs each regulation creates to society. So I'm thinking of conservation areas, so we could do a social cost-benefit analysis for each conservation area, for each view corridor, and we could do the same thing for the green belt. And not all greenbelt land necessarily has to be protected. I'm also not suggesting to concrete over the greenbelt, but there are parts in the greenbelt very close to existing transport infrastructure which doesn't have a high amenity value where we could build. Second, we should consider reforming the tax system. Arguably, we should create incentives, fiscal incentives at the local level to permit development. Or if this, for political reasons, is not possible, then we should consider moving planning decisions to a higher level. The idea is to circumvent NIMBY problems. One particular idea I have been floating for many years is to phase out or replace the stamp duty land tax with an annual locally set proportional property tax. This will create fiscal incentives at the local level. We should arguably also focus on helping people directly rather than places. Like central government grants, we have another paper on this. They are capitalized into higher prices and rents. So they actually benefit homeowners and landlords, not the low-income households you wish to help. So perhaps housing vouchers are a much better solution than these place-based policies. And there is some evidence from France that taxing vacant homes actually works, that it leads to a reduction of vacancies. The last point I want to make is that all of this can only happen if we have a political majority for these reforms. That means we need to persuade the home voters, homeowners who vote to protect their interests. The median voter in this country is clearly a homeowner. And homeowners may think that they benefit from this system because constraining supply rises real house prices. I showed you some statistics on this. But the point is, well, yes, on paper you are wealthier, but you can't actually tap into this wealth. The only way to tap into this wealth is if you move to a different country that has low house prices. So you have to actually leave the country, because if you stay in England or in the UK, I'm afraid housing is expensive, whether you rent or whether you own. So the status quo means you pay more to live worse, because the quality of the housing is not actually that great, especially because of all these conservation areas, etc. It's very difficult to renovate, it's very costly to renovate. So we live worse, and our children will be priced out as a consequence of the status quo. Thank you.
That was fascinating. Thank you so much, Christian. You choose your seats. So have your questions ready. While you think of them, I'm going to pick up where you left off, Christian, about kind of how to get NIMBYs on board with some of this. I mean, obviously, people care lots about the local environments, and you mentioned there about having people understand that they're worse off in some sense. But I wonder if you could comment a bit more on the comparison to Switzerland. I think some people have heard that and maybe think, well, what Switzerland showed is, yes, they've got lower house price, but they've had all this sprawl. You can't undo that. I don't want to get like Switzerland. So kind of what is the lesson there? Is it that you think that NIMBY's fears are overblown, that actually sprawl is not quite as bad as it seems? Are they just underestimating the benefits of having lower house prices and higher quality? How do you, using the international examples, how do you get people who don't want more building on board with the idea of more building, do you think?
Yeah, so it's a very good question, a very difficult one. So first of all, there are NIMBYs everywhere. So the Swiss people are not there, they're as NIMBY, homeowners are as NIMBY as homeowners, maybe more so than in the UK. But there are far fewer homeowners in Switzerland, so the home ownership rate is around 40%, or less than 40%. And so these NIMBY influences are weaker. So that is the first point. And sorry, can you say that?
No, I was just saying, are their fears overblown? I think people worry that if we relax the planning, we would have lots of sprawl and it would make it harder to commute and harder to get anywhere, and there would be fewer doctors and fewer schools. I mean, in some sense, is there a positive message from Switzerland that actually Switzerland's a nice place to live, it's not horrible, we could be like Switzerland and it would be fine?
Yeah, I mean, the one thing that strikes me is that the housing quality is actually much, much better in Switzerland than in this country.
So a plea for better housing. Well, let's take some questions. There are a couple online. Let me take some in the room, and I'll take a group together because I think there are going to be lots of them. Very popular. So I'm going to do it for kind of first come first. So I saw the gentleman here in the kind of beige sweater, and then I'll move across the room. So I'll take I'll group a few at a time.
Yeah. But by the way, so this picture that I showed you was concreting up the Matterhorn. So I looked up the true picture, and there is no housing at all anywhere nearby that whole area of the Matterhorn. So I think it's also overblown. So these sprawl concerns were pushed in the media. They were not really that real.
Great. Thank you. A reminder to hold it close so that everyone online can hear and say who you are. Thank you.
Hello, I'm Callum Harrison from the Association of British Insurers. I'd like to ask, why would you advocate for a proportional property tax over, say, a Georgia's land value tax?
Great, I'll take a few. Can we go to the lady that you're next to, Victor? Oh, other way. Thank you.
Thank you. Thank you very much. I agree with most of your solutions, but I disagree with a lot of your of the earlier analysis. There is zoning. It's called the settlement boundary. I'm a chair of planning in a local council. So that's just one example. The two questions I have to ask you are, why do residential homes which have a planning designation of C3, why are they permitted to be transferred to business rates? This fits in with one of your conclusions. Secondly, more than half of homes and over 3/4 of owner-occupied homes actually have 2 or more spare bedrooms in this country. And so the real problem is the under-occupation of existing homes, which is, of course, very much promoted by the tax system and the fact that the best investment that any individual can make is in a house which is much too big for their needs, rather than the shortage of actual numbers of dwellings. And finally, why does the proposed new super council tax have to employ an extra 1,000 extra civil servants? Why don't they just use self-assessment for valuations and employ civil servants using AI and everything else to check on the most outrageous failures to correctly value homes worth 2 million or more?
Great, it's a lot there, thank you. Let's go one back to the gentleman behind you, and then I'll do that in the transcript. Yeah, thank you.
Thanks very much. Danny Kay from Sheridan Housing and Development Consultancy. Thanks very much. Absolutely fascinating stuff. Like the previous person who's asked the question, I don't agree with everything, but nonetheless, it's very stimulating and thought-provoking. Do you think that if we implemented some of your suggestions, there are a range of potentially unintended and not entirely good consequences? Arguably, if we followed some of your proposed policy areas, it would lead to sprawl, suburban and use of the green belt where it's not necessarily required, at the expense of what are declining town centres and city centres, where there's plenty real estate which could be reused if the regulations and fiscal incentives permitted. And by not using those scarce resources, we have, sadly, dying towns and cities, especially with changing retail patterns, which really ought to be a priority over and above perhaps urban sprawl, suburban sprawl, question mark. Next point is actually, by evidence of this, Historic England produced a study recently which showed that, in theory, there are the equivalent number of heritage properties which, if converted, could deliver 700,000 homes across England.
Brilliant, thank you. Lots of questions there. And can I add another question similar to the first one that's from online? So the first question was about why advocate for a proportional property tax rather than a land value tax. There's also a question online about what are your views on the balance of redistributing tax revenues between local authorities and local authorities retaining more revenue. So obviously if you let local authorities just retain, you might get higher inequalities between areas depending on which ones can attract more buildings. So kind of a group of questions there about kind of what kind of tax you would use and why you would devolve it. I'll let you answer those in any order you see fit.
Okay, great, thank you. So I'm not sure I can answer all of them, but so why proportional annual property tax rather than a land value tax? The answer is I actually had the word land value tax in my slides, and then I opted to take it out because I thought it's more realistic to introduce an annual local property tax rather than a land value tax. But I would agree that in theory a land value tax is actually superior to a property tax. The problem is the land value taxes is a bit more difficult to calculate land values, but I think that shouldn't prevent introducing a land value tax. So I would be in favor of that. I thought it's more realistic to have a proportional property tax. On the point on, so there were some planning related questions, but so the one question that struck me was the 2 or 3 more spare bedrooms in many houses. Well, that is part of the problem that's caused by the tax system. Like we have a stamp duty land tax, and so many people are discouraged to sell their property because it invokes the stamp duty land tax. So what the stamp duty land tax does, it creates a mismatch, not just in the housing market, but also in the not just in the labor market, but also in the housing market. So many elderly people, so their children move out, maybe their partner dies, but they still live in their big house that they bought a long time ago when housing was still affordable. Whereas young families, they would like to expand, but because of the stamp duty, they shy away from it. And so there is some empirical evidence that shows that the stamp duty creates a mismatch. That was one reason why I proposed to phase out, in a tax revenue neutral way, phase out the stamp duty land tax and introduce an annual local property tax or a land value tax. Unintended consequences of these proposed policies. I mean, I only see unintended consequences of the policies that we are implementing. Help to Buy, we have a study on Help to Buy where we showed that what Help to Buy did in the Greater London area is it increased house prices for new built homes, it increased the profits of developers, and it didn't actually increase construction. And this morning we learned it also helps mostly the higher income households and not the lowest income households. So I think that those are unintended consequences of demand side policies. And so you can then say, yes, but it did lead to construction in other areas. So we also did an analysis at the border between England and Wales, and we find that there it actually worked. It did lead to more construction, and it didn't raise house prices. But the problem is the housing shortage is in London, it's in the southeast of the country, and it's not at the border between England and Wales or in the north of the country. So unintended consequences, I can just tell you what happened, or maybe I can show you what happened in Switzerland after, so it's the reverse, but Switzerland essentially changed its planning system, and now the cities can't grow outwards anymore. And what happened is the country still looks as beautiful as it ever did. So I think that the sprawl concerns are actually overblown. But suddenly, so you can see this on the right-hand side, so the cantons got 5 years to implement the policy. And after those 5 years, what we see is exactly what happened in the UK in the 1960s, 1970s, 1980s. Construction starts to go down. Why? Because it's so much more difficult to do inner densification. You need to knock down buildings in the center of cities, which often are protected, which is very difficult. So you can build less, and it's more expensive. Moreover, you have to knock down inexpensive space. If you want to have inner densification, you need to actually knock down the cheap space and build more expensive space. So this is what's happening right now in Switzerland, and the newspapers are full now of housing affordability issues. The same as, I mean, it's like time delayed. What happens in Switzerland right now, what happened in the UK a couple of decades ago. So are there unintended consequences of changing the tax system and changing the planning system? Possibly. Depends how you implement it. It's certainly very complex reforms. I'm not denying that. But I think what the example of Switzerland shows is that, and what the example of the UK showed several decades ago is that by constraining supply in all directions, that must lead to a dramatic housing affordability problem. And if I have to choose between the two, I'd rather have a little bit sprawl than young people not being able to afford housing anymore.
I'm afraid not, because we're actually out of time. And sadly, I'm sorry for other people who missed their questions. We are at time. Hopefully, the discussion will carry on in the next panel. So some of those questions can be brought back for panel. But for now, can you join me in thanking Christian again? Thank you so much, Christian. Thank you. So I'll let you go and join the audience. Thank you very much. So now we're going to seamlessly flow into the panel discussion, which is going to pick up more of these issues on how the government can make progress here. We're going to have 3 speakers. I'm going to introduce them all at once and then just let them speak. And again, we'll come back to a Q&A at the end. So you're first going to hear from Nikhil Datta, who is an assistant professor in the Department of Economics at the University of Warwick and a research associate at the Centre for Economic Performance at the LSE. He's going to talk to us about how to build more homes. You'll then hear from Stani Milcheva, who's a professor in real estate finance and the director of the Affordable Housing Centre at the UCL. She's going to talk to us about shared ownership. And then last but not least, from our very own Peter Lavelle, who's our deputy research director, who will talk to us about some of the consequences of low affordability in the forms of social mobility. Again, then we'll bring them all back together and have a discussion. But for now, let me invite Nikhil to come up. Thank you.
Thanks very much for having me today. So this is joint work along with Amrita Kulka, who is my ongoing co-author at the University of Warwick on pretty much everything that I do. Okay, so there's this big push to build new homes in the UK. I mean, there's always a big push to build new homes. But what we really are thinking about in this project is where should they be built? There's a lot, for example, that you might see in the media or that gets pushed around building new towns. We really wanted to hone in on, if we're going to build a load of houses, where should they be built? And if we want to think about where they should be built, then we should think about demand. We should think about where do people actually want to live. You can stick a new town in the middle of nowhere, but if no one wants to live there, it's going to be really difficult to get developers to build there. It's going to be difficult for them to make profits. It's going to end up being a failure, which we have seen in certain cases historically. And the second part of this, which is touching on some new work we're doing, which is related to then what are the barriers preventing homes from being built where people actually want to live. Now, to do this project, we've got incredibly rich microdata from a very, very large housing search platform in the UK. I'm sure you can use your imagination. And it includes data on every single search. If you have gone onto this housing platform between 2019 and 2024, you've typed in any search, whatever filters you've used, whatever properties you've clicked on, if you've contacted an estate agent, if you've saved things, we can see absolutely everything you can do, but don't worry, we can't identify you. There will be questions around this, around robustness, because I'm sure everyone here has probably looked at house prices in their local neighborhood if they're a homeowner or something like that, which can cause biases. We do a huge amount cleaning this data. It's a massive data set. It's about 20 terabytes of data. We then have supply data, which tells us information on every single listings, unit characteristics, descriptions, final listed sales prices, rent, etc. Between 2019 and 2024. We actually have that data going back to 2010 for some other exercises. We've got information on the rental and own sector, and we do a lot of cleaning where we filter on bots. We restrict to people that only contacted estate agents during sessions, so we know that they're sort of what we call serious searchers and not just someone sort of, bored on the train deciding to look at sort of, I don't know, some famous person's house. One of the interesting things with this is that we think it's the closest we can get to unconstrained preferences. Typically in the UK, when we're looking at analysing sort of housing data, one of the key things you'll look at is final prices. Final prices obviously capture both a combination of supply and demand, and this is a way that we can try to disentangle the two of them. Now, the key measure in this, there are two, but I'm only going to talk about one today, is what we call the housing gap. And this is essentially, it's a measure of excess demand. So you take the number of searches in an area, you take the number of listings in an area, and you take one from the other. We do a lot to make sure searches are only counted once. So for example, if I search both in Hackney and in Holborn, I will get split as half in Hackney and half in Holborn. So there are advantages to this data. It's incredibly spatially fine. People will look up postcodes, they'll look up train stations, they'll look up small neighborhoods. Some people who are maybe more spatially substitutable might look up farther big areas. We can see radii and that sort of thing. We can see searches occurring in places without listings, which is very useful for us because, for example, if you're thinking about building a new town, there are no historical prices for that area. And so we can get sort of information on that, and it's kind of a direct measure of housing demand. There are a bunch of concerns related to aspirational searches. Searchers may well be censoring themselves based on their own budget constraints, and if we think that if you build houses, then prices might adjust, and in equilibrium where they search does adjust, and we do a lot to sort of think about that. I'm not going to go through all of those concerns. There is probably about 15 or 20 pages in the actual report of it, but we do our best to clean it up. One thing I will add is that we do really think about this idea of supply-induced demand. There's this idea that if you build houses, people will come. We've got data on probably about 3 million new builds in the UK over this period, over sort of 2000 to 2024. And we look at really big developments and look at what happens to searches in those areas. And we see that for 100 new units that you build, you might get about one new searcher in that area. So when you build houses, people do not come. One key point that we see is that prices and the housing gap for both rental and sales, they sort of follow what we call the squirrel tail. It's correlated, you know, there is a positive relationship between these things, but in a lot of lower priced areas in the UK, there is large levels of excess demand, and this is unsurprising because prices in areas adjust due to, for example, local income levels, local supply constraints, etc. We calculated the gap for 2019 and 2024. We did this specifically because we were concerned about COVID. There's been a lot about the idea that, you know, people's preferences have changed over time. And actually what we can see is between 2020 and 2023, there is an adjustment. We see people wanting a lot more green space, and then by about 23, it's tanked right back down to the 2020 initial, which is quite a nice result. Now, where is the highest gap? Where is the housing gap highest in the UK? So this is at the output area level. Sorry, not UK. I got shouted at on Twitter for that. Great Britain. So this is 235,000 output areas in Great Britain. These are the redder the area, the higher the housing gap. This is in ranks, so you can think about it as quantiles, and it's just so that it's easy to interpret scalable-wise. Now, unsurprisingly, the highest housing gaps are in cities. People want to live in cities. People don't really want to live in new towns. We've sort of dug into this quite a lot. We have tried to understand why, and I'll go into a little bit of detail about that. But sort of the first key finding from this is that 2/3 of the excess demand variation is within LAs. So what that means is that when you're thinking about giving local authority level targets, that's not really going to be picking up particularly well where people want to live. So these are two examples. This here on the left is Islington, this on the right is Hillingdon. Bear in mind that these scales are very, very different. But in Islington, there are some super, super hot areas, and then there are areas as you go further north which do get a fair bit lower. If you go to Hillingdon, you could, for example, set a housing target in Hillingdon, and the local council may decide to build those in an area, in a new town, or further away from where there are pre-existing houses, potentially because they don't want to upset local voters. And some of those areas are just going to be incredibly undesirable. Some of these undesirable areas are very easily predictable. For example, they're right next to Heathrow Airport, or they're within flight paths, and therefore no one really wants to live around there. This is a good example for one of the new towns that's been put forward around Greenwich, which has been put right next to City Airport and 2 different sewage treatment plants, which is a really bad idea. And we show, sort of looking at this data, that that's a really bad idea. Now, we split the housing gap into 4 different types of areas. One, which we call densification, that's essentially within the inner 50% of major cities, the top 5 cities in Great Britain, or within the inner 70% of smaller cities. By a huge sort of margin, that is where people want to live. That's where the largest excess demand is. However, when we look at building data over the last 20 years, only about 29% of houses are there. So we can see a gap. Now, there's a lot of discussion about urban sprawl. Most of the houses that we've seen built, actually the top winner out of these 4 categories over the last 10, 20 years have been what we call urban extensions. So these are sort of on the outskirts of cities, around around 1 to 2 kilometers outside of a city, essentially extending it. About 40% of the houses are there. And there are housing gaps there, but they're not as large as densification. Small towns extensions are similar to urban extensions, but they're just smaller towns. I can't remember the exact population size we used for that cut. And then about 12% have been new rural developments, where again, there is generally a very low housing gap. What predicts high housing gap? Nothing here is causal. We don't make any claims on causality here. This is just very much correlational, thinking about what it is that predicts a high level of excess demand, a high level of demand relative to available housing. And sort of when we're looking at the principal components, the sort of urban amenity index, and this is really, your local consumption amenities. This is about being able to walk to shops or being able to get to a leisure centre or a theatre or something along these lines within a very localised area stands out by far the highest. We also created a natural amenity index. It's negative. It's negative, obviously, because, it comes out as negative. And then we also had a look at these sort of what we call negative infrastructure, so recycling centres, refuse disposal facilities, waste storage processing and disposal, and again, they're all negative. There's also a version of this which I think is actually, there's a version of this which we haven't included in this, where we include job access, and job access also comes up, unsurprisingly, incredibly high. So people want to live, what we try to really pushes is that what we see happening is that people want to live in dense cities with a lot of local consumption amenities and also public amenities as well. And this is important because when we're thinking about new towns in particular, and I know I harp on about new towns, it's because I just wrote a report on them, it's really difficult to attract consumption amenities to new towns. If I'm a business, I'm a restaurateur, anything like that, if I'm going to go and set up in a new town, I want a lot of people already there. Which, and if you want to get those people there, they usually need the consumption amenities. So there's a problem with organising that. Now, this data that we've done with these calculations, I hope this works, is not just for us, it is for the general public and for policymakers, and we have created this where to build mapping tool. And essentially what this shows you is it tells us exactly what I was just showing you, where the housing gap is the highest. You can search. So, for example, let's say that I was a policymaker working on new towns, and I wanted to see whether it was a good idea to build the new town around Enfield Cruise, which is just around here. You can see that it's probably not a good idea. Okay? And so there's a whole different types of measures here. There are measures on gaps and tightness and that sort of thing as well, which is another measure that we created. The other thing that we've added to this, and this goes back to a couple of things that Christian was talking about, we've added planning designations to this. So you can see, for example, where the conservation areas are. You can overlap them here, and you can do the exact same thing for green belts. So you can actually take a look, you can think about a restrictive planning designation, and you can have a look on this, and you can say, okay, maybe that part of the green belt is a good idea to deregulate. If you want to do it very selectively, this sort of offers that information to you and for policymakers. And so the website is just that, wheretobuild.warwick.ac.uk. So in the last 2 minutes, I'll just quickly talk about planning barriers. So about 25% of the excess demand lies in areas with restricting planning designations, and by far the sort of largest number is in green belts, but then also conservation areas play quite an important role here as well. Now, when we think about green belts, this is not, people can get sensitive about green belts. We're not suggesting that you should build on green belts everywhere. We're suggesting, and it goes back again to what Christian was saying earlier, that there are particular areas of green belts, and they tend to be those which are very close to cities already that have got good access, where it might be a good idea to build. So there are particular areas around Leeds, around Sheffield, etc., where we can see the Northwest Green Belt in particular has got a number of these areas where, if we were to propose to build on some green belts, they are. Now, when we look at London, on the other hand, London does not have that. There are certain areas around London, there definitely are, but there are a number of areas in the London green belt where we would suggest it's not a good idea to build. And in fact, when we just look at the cumulative gap on green belts, and we look at the cumulative green belt area, if you were to just build on about 10% of green belts, that would cover the majority of excess demand for housing in green belt areas, which really pushes this idea that it's just select green belt areas that if we could push, we would suggest to deregulate. So the sort of key takeaways from this is that really, we think that there should be a focus on where to build within local authorities. It would be great if local authorities, when producing their local plans, could think about where the demand is in their areas. And again, just to add, one of the things that we see is that when planning is given for areas with low excess demand, build-out rates are incredibly slow. And it's because developers can't sell their houses or to profit maximize, they're going to drip feed them into the market because there's not that adequate excess demand to soak them up. We would also sort of suggest to identify sites for densification and increase the proportion of housing delivered in the form of identification to 70%. We would also suggest allowing building on parts of the green belt with the highest excess demand, and that any policymakers working in this area, any developers wanting to know where there is high demand, please use the mapping tool and feel free to get in touch. Thanks very much.
I'm going to resist the urge to sit here and play with the mapping tool. Let me invite Stani up to the podium. So Stani Milcheva from UCL to talk to us about shared ownership. And I'll invite Nikhil back at the end to join the panel. Thank you.
Thanks very much for the opportunity to speak here. I learned a lot today, so sorry. And I will talk a little bit about shared ownership. So we have an extensive portfolio of research. So I just picked a few slides here to kind of introduce you to this affordable tenure. A little bit about the history of shared ownership. It started a long time ago. So in the early 80s, we had shared ownership, which is a partially, it's a hybrid tenure where you partially own and partially pay rent. In the early 2000s, the eligibility rules changed, and they were extended to high-income people. So now people on incomes of up to 80,000 outside of London and up to 90,000 in London can qualify to buy shared ownership. And the main supply of shared ownership occurs through two mechanisms. One is the Affordable Homes Program, which is the largest subsidy for new supply of affordable housing, either via Homes England or the Greater London Authority. And the other one is through the so-called Section 106, through the planning obligations of new developments. So as I mentioned, what is shared ownership? A household can buy a percentage of a home which is designated as shared ownership. And at the moment, the percentage is 10%. It used to be 25% minimum. And they can put only 5% deposit. I will give you an example. And on the remainder, they pay subsidized rent. So the subsidy occurs on the rental part. And there is a formula how the rent is calculated. Normally, this is like a rental yield for the owner of the remainder of the percentage. So the so-called institutional investor, that in most cases is a non-profit housing association, or they also called registered provider. So the rent is 2.75% of the value of the shares that the household doesn't purchase. And it grows with inflation, and the household can buy more shares as and when they see appropriate. So there are three stakeholders in this. So the shared owner, who is the owner of the home, the registered provider, who owns the other share and receives rent, and the mortgage lender. So the mortgage lender would provide a classic mortgage to the shared owner of up to 95% loan-to-value ratio on the share, not on the whole property value. So we can see here what happened with new supply of affordable housing. The green line shows social rent. So these are the three affordable tenures. So mostly it's rental, mostly historically it's been rental products. So social rent is probably what most of you are familiar with. And that's kind of had the biggest share. But in 2010, we see this sharp drop of new supply of social rent. And instead, we see that's been replaced by the blue line, which is affordable rent. Affordable rent is less subsidized rent. It's based on the average rent in the area, so about 80% of the area in the market, whereas social rent is based on the individual household circumstances and based on income. And also we see shared ownership, which is the red line. Previously, that existed, but in the statistics, it was called affordable home ownership. So you can see the supply hasn't changed much, but what we see in this graph is that the percentage of new supply of total housing of shared ownership has increased from 2015 to 2021. So it used to be 2.5% of all supply of housing, and in 2022, it's 9.2%. So it's a significant percentage of supply of housing. The stock of shared ownership is not large. It's like 200,000 to 300,000 units. So I will present some very preliminary results on a study that we're doing with the product sales data. This is administrative data collected from the Financial Conduct Authority and covers the universe of mortgages in the UK. Our sample starts in 2015, since that's when we can track shared ownership properties. Before that, we can't identify the shared ownership properties in the data, and ends in 2025. So you can see from this one, summary statistics, that shared ownership, the average house price is slightly less than traditional ownership. But what's really different between shared owners and households that get a traditional mortgage that don't buy shared ownership is the income. So shared owners have an average income of 42,000, whereas traditional owners, as we call them, have an average income of 68,000. And the other difference is in the loan-to-value ratio. So there are two ways of measuring loan-to-value. One is when we look at the full value of the home. Shared owners have a LTV of 82%, whereas traditional owners have an LTV of 72%. However, if you look at the share that's been purchased on which the loan has been provided, sorry, that's the share on which it has been purchased, so 82% of the share value. If you look at the full price, the loan to value is 39%. And lenders have something called mortgagee guarantee, which reduces their exposure to credit risk. And another major difference between shared ownership homes and traditional ownership homes is in the tenure type. You can see that the shared ownership homes are to 28.7% purpose-built flats or maisonettes, whereas traditional ownership is only 8%. In turn, traditional owners mostly use the loans to buy detached homes, 22%, whereas shared owners buy only 6% detached houses. And the other main difference as well is that shared owners are mostly first-time buyers, so 85% are first-time buyers, whereas traditional owners are 35%. So this is people that buy using a mortgage. We can't track cash buyers here, but really shared ownership helps first-time buyers, which otherwise would have not been able to afford to buy a home. So let me give you an example on affordability. And I think that kind of relates to what has been presented in the beginning of today's session. So we look at a household buying 25% share, cash deposit of 20,000. We assume an interest rate of 4% and a mortgage that's been taken over 30 years. We assume fixed interest rate. Annual rent on the unowned share is 2.75% of the value of the share, and annual service charge 1%. That's a pretty realistic estimate, having looked at some service charge data as well. And we assume a net household income of 36,700, which is the national median for 2024. Then we apply the affordability constraints. So there are two types of affordability constraints. One applies to properties being built in the Greater London Authority, and the other is by properties outside of it. And roughly, what it says here is that for the GLA, the mortgage plus the rent plus the service charge should not exceed 40% of the net disposable income. In the rest of England, the constraint is slightly different. This is our own take on those constraints. The mortgage should be less than 30% of the income minus the rent minus the service charge. So when we look at what a shared owner can afford, we see that in London, the maximum house that they can buy is worth 352,000, whereas outside London, it's 517,000. So the constraint is more binding in London, which is the least affordable area. And then we calculate the maximum price to income ratio. And we see that with shared ownership, households can push this price to income ratio to 9.5 in London versus 14 times their income outside London. So this is a graphical representation on the maximum house price to income ratio, depending on the share being purchased. So the smaller the share, let's say the smallest share is 10%, the higher the maximum house price to income ratio would be. That means that if you buy a very small share, you can afford a very expensive house and still fit in within these affordability constraints which need to apply when you get a mortgage for shared ownership home. And you can see the difference. The orange line is homes England, so outside London, and the blue line is London. So again, the constraints are more binding in London as compared to outside London. And as your share grows, you can buy a less expensive home. So you can't afford to buy a more expensive home or a larger home. So this is what I have shown you. And in terms of monthly payments, if you look at affordability in terms of monthly payments rather than other metrics, we also, just to give you an example, we take a property worth 269,000, which is the average value of a home in the UK in June 2025, and a hypothetical share of 25%, and we compare the costs for those two. So as always, shared ownership CM is the conventional mortgage. So the mortgage payment would be much less because you only buy a 25% share. Instead, you pay rent, but the rent, as I said, is subsidized and is 2.75% of the 267,000 times 0.75, so the residual share, and a service charge of 224 for both properties. So there is no difference in the service charge, assuming this is an apartment. And so you can see that the total cost for shared ownership are 914. This is the initial cost at the point of entry, and not later on when you, if you want to buy more shares. So this is at the point of entry. We don't look at cases when households want to buy more shares. As compared to conventional mortgage where you need to pay 1,400. So shared ownership is more affordable here in the sense that you pay less on housing costs, but of course you own only 25% instead of 100%. So if you look at the wealth over time, you might have less wealth because you would benefit less on the increase in equity if house prices go up, but at the same time, you're less exposed to negative shocks in house prices. So if house prices go down, you'll be less affected by that. So it's, in a way, you can look at it as a hedge, whereas the rent is fully predictable. And that is confirmed also by our regression results. So here we regress the price-to-income ratio on property characteristics, loan characteristics, household characteristics, so a host of controls, fixed effects, etc. But the main comparison is this dummy for shared ownership and dummy for traditional conventional mortgage. And we see that, yes, they're both significant, but shared ownership is more significant, so 1.62 is the SO dummy, which means that relative to comparable households purchasing with standard mortgages, shared owners buy homes with price-to-income ratios higher by roughly 2 years of annual income. We also see some other results that it allows shared owners to get on the property ladder sooner, and otherwise they should wait to increase either their incomes or their deposit to buy. The composition attributes most of the differential to the relaxation of binding affordability constraints embedded in the shared ownership contract rather than to the selection of unobserved preferences. And the remaining component is consistent with households valuing the shared ownership contractual risk sharing in the form of reduced exposure to house price risk through partial equity and lower initial leverage that limits interest rate sensitivity. So they are exposed less to house price risk. Okay, and to wrap up, it's something that we designed. It's a website called shareown.info where households can compare these two options, purchasing a home with a traditional mortgage versus buying shared ownership for an identical property. They can select the area, they can provide some information on their savings, income, etc. And then we estimate their household wealth up until retirement. So they need to indicate the age at which they are as well, so they can compare the household wealth if they were to buy shared ownership versus if they were to, let's say, wait and buy using a traditional mortgage. And also we provide some staircasing options. I did not talk here about staircasing, but that's essentially the possibility to buy more shares in the home, which is a very, very complex decision with many moving parts, which is not easy to make. But we assume in this calculator, essentially, that any saving that the household has is put back into the property and is leveraged up to the housing affordability limits, which are allowed by the regulators. And that way of staircasing is used to see how the housing wealth will grow were they to buy more and more shares. Of course, there are many different strategies about that. So I will finish with that, but there is a lot more on this product. Just kind of the key takeaway is that it increases access to home ownership for people on lower incomes that otherwise wouldn't have been able to access home ownership. Thank you.
Brilliant, thank you. Another website for us to check out.
Much. My presentation is going to be a little bit different because unlike the previous three speakers, I'm not going to be providing useful, helpful, constructive solutions. I'm just going to be bringing more problems and issues. Anyways, hopefully still interesting. So this is some work I've been doing with my colleague David Starrick, who's how do house prices affect social mobility? And this is also work that was, like this event and like Bee's presentation, generously funded by Homes England. So there's a little acknowledgement. We're going to be using some interesting data that links people across censuses over time, which allows them to track their movements over time. This is some disclaimers to say that neither the funders nor the data owners endorse any of the interpretations we have of their data. Whoops, I sent the wrong presentation, but it doesn't matter. So there's two ways that higher house prices are going to affect social mobility. Higher house prices are going to affect social mobility because they affect where you can move. Is it possible to access the most prosperous labor markets? Rising house prices also affect social mobility because they have uneven consequences for different people. So some people will see large wealth gains, people who own their homes, people who own their homes in the right places, whereas people who are renting will not see those gains, and that will affect, when you're thinking about the next generation, the resources that are available to that next generation. So in this paper, we're thinking about how that high house price boom, so as we heard, it mainly occurred in the late 1990s and early 2000s, how that affected social mobility. And this is just to show you the house price boom. This is a figure that we've seen before, but there's very large increase in house prices, especially over the 1990s and the early 2000s. That was very uneven geographically, so people in London saw much higher increases in house prices, and for those who are owning in those places, much greater increases in housing wealth than did people in, for example, the northeast of England. So drilling down into some more specific questions. The first one is, does parents' housing wealth shape young people's choices over where to locate and the labor market opportunities they're able to enjoy? So that's one mechanism through which it will affect social mobility. And more fundamentally, can we identify a causal role for parents' wealth in terms of its impact on children's outcomes? So there's a whole host of evidence that says that children from wealthier backgrounds, they tend to have higher incomes, better health, and so on and so forth. We know that, but this could just be a correlation. This might not necessarily be the causal role of wealth in affecting those outcomes. And here we're in particular interested in the causal role of housing wealth in affecting these people's later outcomes. So I'll explain how we try to do that. So the data we're using, so we're using data that's been linked across different censuses through what's called the ONS longitudinal study that runs from 1971 until it's most recently incorporated the census of 2021, but because of lags in terms of getting access to that data, so far we've only included data up to the 2011 census. So what this allows us to do is we can see individuals as they responded to the census, or maybe their parents responded for them when they were children, and we'll also see the other people in the household, including their parents, the type of house they were in, because you answer questions about that in the census. So we can see that when they're growing up, and then we can track these individuals decades later when they've left home. And we're going to use this to compare children from who grew up during that boom period, so some of whose parents will enjoyed great large wealth gains during that boom period. So these are people born 1974 to 1983. So we can compare them with each other. So parents, children who grew up in households with greater or lesser increases in housing wealth. And we could also compare them with a previous cohort which didn't grow up in a period of really rapidly rising house prices. These are people that were growing up in the 1991 census. So this is the sort of cohort of interest, the boom cohort. So they grew up, they were aged 8 to 17 in 1991. In 2011, they were in adulthood, 28 to 37, and that's when we're looking at their outcomes. So unfortunately, the census does not ask the value of your home. It doesn't ask also questions about your earnings. But it does ask a lot of details about the rest of your life. So it asks about the type of house you're in. We know the location of the house you're in. We know your tenure type. And in terms of earnings, we know the occupations, industries, people working in, the hours they work, and again, where they're working. So we use this information to kind of piece together good estimates of people's housing wealth and of their earnings. So the challenge we have is that we want to compare the outcomes of children with parents with more or less housing wealth. But outcomes are determined by many factors that might be correlated with housing wealth. So it's things like things that can be transmitted from parents to children. So one is, of course, house prices, but it's also, so the local economy might be doing well. So house prices might be driven up in an area because the local economy is doing well. That might mean that the children do better. Nothing to do with parents' housing wealth. It's just because the labour market's doing better. Well, the other thing is that so parents that live in certain areas or parents that have higher housing wealth, that might reflect some of their preferences that they transmit to their children, and might also affect labour market outcomes. So yes, this key question, is it the fact that when we see children of wealthier parents are wealthier themselves, is this reflecting the impact of the parents' resources, such as the housing wealth, or these other things that might be correlated with those outcomes? The ideal experiment to deal with is to randomly hand out housing wealth and see how that, to some parents and others, and see the impact of that on children. Obviously, for various reasons, we're not doing that. We don't have the research budget quite yet to do something like that. So instead, our approach is to do something different, so as close as we can to that experiment. So we're going to take some outcomes, so for example, your ownership rates when these children are adults. And we're going to compare the gap in this outcome for the children of owners and the children of renters. And then what we're going to look at is when we compare across areas that saw greater or lesser increases in house prices over time, we can see if that gap's getting wider. So in areas with higher house prices, the gap is wider than it is in areas which saw lower house price growth. And then the other thing we can do is we can then compare that to a previous cohort where we didn't see that house price boom, and see whether we again see that same pattern of a widening gap. In addition, we can control for a bunch of parents' characteristics. So we can control for things like parents' occupation, education, and other characteristics. And the analysis we have in the paper controls for all of those things. But this is a kind of graphical illustration of our approach. So here we're looking at the children's housing wealth when they're adults. And on the left-hand side, we've got people who grew up in this pre-boom cohort. So these were growing up in a period when house prices weren't rising rapidly. And on the x-axis, we've ranked the areas they're in according to how rapidly house prices were going up in that later boom period. So the areas that saw really rapid house price growth in London will be on the right-hand side of that chart, and places that saw smaller house price growth in that boom period will be on the left-hand side of that chart. And the red line is the children of renters, and the black line is the children of owners. And what you can see is that children of both renters and owners had more housing wealth if they grew up in what would later turn out to be a booming area. But the gap doesn't seem to vary that much between renters and owners as you look across areas that saw rapid versus slow house price growth. And then on the right-hand panel, what we've done is that same graph, but this is for people growing up in the boom period. And again, so you see, so owners, they're more likely to have more housing wealth than renters. There's this upward sloping pattern, so people who grew up in booming areas, they're likely to do better. But that gap between owners and renters is now getting wider as if you're in an area that saw really rapid house price growth. So that's something that's sort of indicating that housing wealth here is playing a causal role in meaning that the children of those parents that do better out of the housing boom have higher housing wealth themselves. So that's for your total housing wealth. The other thing we can look at is just an indicator for whether you're a homeowner. And so here we've done the same exercise. And so here we've got the pre-boom cohort again. So you see, again, there's this difference between the children of renters and the children of owners, but that doesn't seem to vary according to how rapidly house prices were going up in those areas. And then we've got the post-boom cohort. So here the pattern's a little bit different in that what you see is that, again, in the post-boom cohort, this gap doesn't seem to be growing too much with house price growth rank. So from what these, the takeaway from these two joint pieces of analysis is, and by the way, all of this holds up to a kind of more sophisticated regression analysis. This is the graphical illustration, but we've done our homework as well. Taking it all together, so parents, if you have £100,000 more gross housing wealth, causes a child to have £15,000 more gross housing wealth in adulthood. That's the takeaway number. But as what that previous figure shows is there's no impact on kind of home ownership rates, so this effect of getting on the housing ladder. And what this says is that the children of the parents who did better, the children of the richer parents, were just as likely to buy, but when they did, they bought more valuable homes. So what accounts for this slightly puzzling pattern? So the key thing is where people are buying when they buy. So this is a similar analysis, but looking at a different outcome. So looking at the effect of where the children live on the basis of how much additional housing wealth the parents got out of the housing boom. And what you can see, it's at the bottom there is London. So there's this effect both in the likelihood that a child growing up in London to stay in London, according to the housing wealth they have, but also if they grew up outside of London in terms of the probability they move to London. And the same is true for the rest of the southeast. So what this says is that these children are moving to more expensive housing markets. So it's not having so much of an effect on their home ownership rate, partly because they're moving to a more expensive housing market, so it will take them naturally longer to become a homeowner. But when conditional on when they buy, they'll also have access to, they will then own a more expensive house in terms of their gross housing wealth. So this raises another interesting possibility, is that what Parent House is doing is it's giving access to these children to the most prosperous labour market, so places in London and the South East where they're more likely to get higher wages, higher earnings. And so the next question we can ask is did this advantage of parental housing wealth translate into greater success into the labour market as well? And like I said, so earnings themselves aren't asked about in the census, so we're inferring their earnings based on their occupation. If you're working in investment banking in London, we assume you're doing quite well, that's how we do it. And so here we've got the effects of the earnings quantile, the estimated earnings quantile these people are in. Again, this is the impact of having your parents getting an extra £100,000 of housing wealth over that boom period. And so we see very different results for men and women, which is quite interesting. And we can talk about it in Q&A, but we haven't got a full answer as to why that is at the moment. But what the interesting thing is, so for men, what you see is that they're less likely to be in these middle-earning occupations, and they're more likely to be in these very high-earning occupations, in particular in the top 5–10%, which is suggestive that the parental housing wealth is having this impact, not only in terms of the child's wealth, but in terms of their earning capacity, partly through this fact that they're able to access different labour markets. Whereas for women, we don't see very much effect on the earnings later in life of parents' housing wealth. So to summarize all of that, so what we find is, so the children of parents who benefit most from the property boom, they're more likely to have greater property wealth themselves, to own homes in London, and for men to enter the highest earning occupations. So this confirms property wealth gains among parents, confirms advantages to their offspring. And then in terms of what that means for policy, so it means that the policies that affect housing wealth gain in a previous generation, or housing wealth gains now for subsequent generations, these policies are going to affect social mobility, and that has implications for the way we tax housing wealth gains, the impact that would have on intergenerational mobility, and also since as we've been hearing, housing supply constraints are very important to determine how large these house price booms are in the first place. Those also likely have implications for intergenerational social mobility as well. So I think I'm finished, so we can...
Brilliant. Yeah, so if all our speakers come back, we can get ready for the panel. But for now, thank you, Peter. Brilliant, thank you. So there are already some questions online. Have your questions ready. I'm going to start with just one very kind of like quick, the top question on Slido, which is very specifically to Peter about this stuff, and then we'll widen it up. So the question, Peter, is how do you think the housing crisis will affect young people today? So not the people you've looked at in the past, but the kind of new cohorts. And do you think the Renters' Right Act will be implemented, to be implemented will make a difference? So what was it like going forward, I think is the question. Current young people.
The current house crisis for
the next generation.
For the next generation. Well, so we're in a kind of different situation. So we're in an equilibrium where house prices are very high and unaffordable. But then it's not. The difference is that they're not rising quite as rapidly as they were before. So what it means is that for now, what we're seeing is the kind of fruits of the previous boom in the sense that there's inequalities in terms of what people can afford, based on what happened to their parents, in a large part whether those parents happen to have been owners in the right locations to really enjoy the fruits of that boom. So that's the implication for the generation today in terms of access to home ownership. But are we going to see a repeat of that for the next generation? That's less likely, because we're not in this period of really rapidly rising house prices. So it's not that you see unequal wealth gains. What you see is unequal access to home ownership based on what happened to the previous generation.
Great, thank you. Okay, I'll take a selection of questions from the room, then I'll weave in some questions from online too. So if you've got a question, pop your hands up and we'll get a microphone to you. Okay, so we'll go to the gentleman here. Thank you.
Me again. Danny Kay from Sheridan. One question for each. So starting on the left. Sorry, I can't remember your name, but it's...
Peter.
I'm Peter.
Peter, thank you. So do you think, very interesting, thank you. Arguably, it could be argued that we've reached peak London in terms of affordability. And if you look at demographic data, that there are beginning to be signs that people are moving out of London, and indeed we might indeed have the effects of levelling up, where younger generations are moving to the northern cities. By default or by design, do you agree with that? And what do you think of the implications of that? Question for, I can't remember your name, sorry.
It's Nikhil.
So, Neil. What you are advocating, arguably, is
quite a criticism of the existing, the current Labour government's planning policy. Do you agree with that statement? And if so, what would you say to the Secretary of State in terms of taking on board your advice? And the final question, thank you, in terms of shared ownership, that appears to be quite a compelling argument for continuing shared ownership via Section 106, but also grant funded by Homes England and the GLA. Do you agree with that? And do you agree that it represents arguably better value for money than equivalent forms of subsidy, for example, Help to Buy?
Okay, let's take each of those in turn. Peter, would you like to go first? Have we reached peak London?
Have we reached peak London? Yeah, I don't know. But in terms of sort of the question, so people moving out, so, I mean, I've seen the same statistics that, so young people more likely to be moving out, partly because of high housing costs. I guess, so the implication of the research is kind of, well, who are those people? And it's a select group that are staying, and then a differently selected group of people that are leaving. And there's clearly still a high wage premium from being in the capital. There's all the benefits of agglomeration and density that does mean that there's an earning premium here. And it's like that group that is selected that can stay will continue to benefit from that. And what our analysis is kind of suggesting is part of what determines that group is what happened basically to your parents. So your parents' wealth determines your ability to remain in this increasingly expensive housing market and reap the benefits of that.
Great, thank you. Nicola, you critiqued new towns. What's your advice to the Secretary of State?
So one thing I would say is that I don't critique. I think the goal of building 1.5 million homes, or whatever I think the actual number is 1.8 million, but it's a lot less catchy. Over 5 years is a great goal. It's incredibly unrealistic. I would also say that I was sort of batting down new towns today quite a lot. Only 200,000 of those are meant to be in new towns. So it's not the idea that all of the new homes are meant to be in new towns. I would also say that 2 of the new towns proposed are not actually new towns. They're densification in Manchester and Leeds, and I think they're great. I think they're absolute winners, and I think they should go ahead. And I imagine that if they do go ahead, they'll probably get built and sold very quickly from a developer perspective. The last thing I would say is that the research that we're doing at the moment, we've scraped 18 million planning applications from all local authority planning portals, and we're running sort of text analysis over huge numbers of decision notices to specifically look at what are the conditions that come up in things that are accepted. Because while about 20% of proposed homes are rejected, about 50% of accepted homes are never built. And a lot of that is because of the fact that there are a huge number of conditions that are placed on these. Some of this touches on what Christian was talking about earlier. S106s is a negotiating sort of avenue for local councils to try to extract money from developers to pay for certain things. And if that wasn't the case, that may well open up a lot of these things that were actually accepted to get built. And so we're trying to pinpoint some of those. And again, it's not just planning, it's also building control. So for example, recently Sadiq Khan actually relaxed the sort of dual aspect requirements for London, which again is likely to make it easier to build. So I think one of the things that I would push if I was to say anything to the Secretary of State is that there are going to be specific planning regulations associated with conditions. It might be environmental, it might be on protection of conservation, and specific aspects of building control, which when you look at the cost-benefit analysis is a terrible idea. And that's sort of what I would probably say to really focus on.
Great, thank you. Stanley, there's a question about shared ownership. I'm going to wrap in another question from online. So the question here was basically, is it good? The question online is, to what extent does shared ownership in London act as a misleading form of affordable housing, given it often remains financially burdensome for first-time buyers and families due to the combined costs of mortgages, rent and service charges? So you can take both of those sets of questions together.
Thank you. Yes, I think we should continue with shared ownership to answer your question. In terms of comparing with the Help to Buy, shared ownership is a supply side policy. So the subsidy, the government subsidy is applied at the point of building the home. So it subsidizes the construction of shared ownership homes. And we don't expect that to lead to the same house price increases as Help to Buy. It also targets different kind of households. So we see lower income households being targeted, which in most cases wouldn't be able to buy a home in the same location. So in terms of value for money for the government, I mean, there are government evaluations going on the Help to Buy currently as well. So it remains to be evaluated in terms of value for money for the government. But it is, for households, it's a stepping stone to home ownership. And the kind of the counterfactual is the rental market. So you're not comparing to what would happen if you were to buy traditional ownership, because the shared ownership requirements say that households that buy shared ownership should not be able to buy a home in the same location and the same price. So there are these affordability constraints that apply. And yes, I think there is a lot of bad reputation around shared ownership. I think it's probably about how it's sold, because it is a hybrid product. But in the statistics, it counts as a home ownership product. So it increases home ownership. However, you can buy a 10% share and be called a homeowner in the statistics. So I think it's very important, people going into home ownership, to inform themselves fully of all the costs and how the costs will be growing, especially things around service charges, which you know, has been shown to grow. The rent is fully predictable. And then it's the mortgage cost, which very heavily depends on the kind of the interest rate environment. But the exposure to the mortgage cost is smaller than if you were to buy with the traditional ownership. And so you are also a tenant. So you have your tenant obligations as well, but at the same time, you're responsible for the full costs of a homeowner. So you fully pay the service charge and all the other costs around the property. So I think it's a messaging issue in terms of what actually you're buying. And the other issue, which I didn't talk about, is about the liquidity of the market. So what happens if you want to sell your home? What happens if you want to buy more shares? So we are trying to do some research around that. There is very limited data to look at how easy it is to sell a shared ownership home. Is it less liquid? People say, we feel trapped. Often that links more to the nature of the tenure, being a leasehold structure rather than a freehold structure. In London, the majority of the shared ownership tenure is a leasehold structure. Outside London, in the northeast, is a freehold structure. So they're kind of catering to two different purposes. Outside, in the affordable areas, households use it to buy large houses. In London, they use it to get on the housing ladder, buying an apartment, which otherwise they wouldn't be able to afford as a kind of single household. So I think it's a very complex product, even for someone like me who understands it. So we need to inform households much more on what they're getting themselves into. But I think overall is a product that allows home ownership entry for people that otherwise wouldn't be able to have it.
Brilliant, thank you. There's a set of questions on Slido that I'm going to group together, because there's actually quite a lot of interest in questions of the form, what else could the government do that we haven't talked about? So obviously there's just building more houses. That aside, the other suggestions being raised are things like, do we need to change the thresholds in the Help to Buy or ISAs, or have broader reforms to those financial products that make them more available? Do we need to require developers to build a greater proportion of new builds, make vacant properties into intermediate rent and London living rent schemes? Do the government need to be directly purchasing or reclaiming homes and expanding social housing? So basically a question there, I think, a set of questions there about, you know, given the stock of housing, what else can the government be doing that tries to make a difference here? Do any of you want to tackle that?
I'll start, yeah. So I'll talk about the Help to Buy thing. So that was obviously something we talked about this morning. So the sort of natural reaction to seeing, okay, so it's really the loan-to-income constraint that constrains a lot of people. So when you introduce a deposit help, that means that it tends to be the high-income, low-deposit people that benefit most from that. And then the sort of natural reaction is, well, why don't we just make it income contingent in some way? Or why don't we make it easier for people on low incomes? But then you are in this situation where you are pushing these people to take on something quite risky. So someone on low income, helping them into home ownership, helping them to get a large mortgage, there's obvious benefits to that. But then they are what's in effect a subprime borrower, right? There's reason that the bank wouldn't lend to this person in the first place. And if the government's taking on that risk, that involves risk both for the government and for the person themselves. So there's a very kind of careful trade-off that one needs to navigate before you immediately leap from, okay, well, we need to condition these schemes in income in some way, make them more generous to people on low incomes, to think about, well, what are actually the risks that we're putting these people into and the government is taking on itself. I'll leave the other kind of things to.
Of course, but worth pointing out, because it's a subsidy to get on the ladder, it's not helping you in the long run afford that home. And as you said, people often couldn't afford that home in advance. Nikhil, do you want to add to that?
Sure. I'll just mention a couple of things. One is, I appreciate it was given the existing stock of housing, but I will just say that there's a lot of old grey belt, sort of greyfield properties, which could have scope for conversions. Again, one of the difficulties with converting, for example, old office blocks or greyfield properties is building control. You need to have a certain amount of light, you need to have a certain amount of headroom, you need to have certain things in there. And certain aspects of building control, for example, we would always want to keep fire safety, those sorts of things. Other aspects could be relaxed such that you can then create what would essentially be lower quality housing, but would also be more affordable housing. The other two things I'll talk about are related to sort of more competition and rent seeking. So there's a paper that a co-author and I, Jan David Bakker, who's at Bocconi, we did, where we were looking at the Tenant Fee Act. Now, it sort of only touches around the edges, but the Tenant Fee Act banned letting agents from charging tenant fees to tenants at the start of tenancies, and some of these are quite expensive. You're talking about around sort of like £500 to £1,000 at the start of a tenancy, which for someone on low income can be a large amount of money. And I think a lot of people, when it was going through, especially if you believed sort of ALA or the letting agent sort of lobbying body, that this would just get passed back through to someone. And actually it didn't. And the reason it didn't was because these tenant fees were typically hidden fees and therefore acted as a form of rent seeking. And so there have been some sensible policies that have actually already sort of touched around the edges a little bit. The other side around competition policy that I'll also talk about is that we know that the planning system makes it difficult for developers to build, and there is a lot more paperwork, a lot more filings, a lot more, for example, you've got to do environmental impact assessments, these sorts of things, which become prohibitively difficult for small developers. And as a result, there is increased concentration in the developer market. Again, I think Christian's got some work on this. And we know that whenever any market becomes less competitive, prices tend to increase. And therefore, thinking about sort of competition policy in the developer market, again, is probably something that would require some attention. And I do know that the CMA did do a report on the developer market, I think in 2023. I don't entirely agree with all their findings, but I think it's sort of an avenue that requires more exploration.
It's a great example of those unintended consequences of some of the current rules. Stanley, do you want to add anything to any of that?
Maybe just that obviously currently construction has been stalled, right? And I think that the government, I can imagine the government is exploring a lot of different ways to stimulate construction. One thing is to maybe move away from this speculative development way of building and selling within 2-3 years and relying on short-term house price effects into kind of patient capital investment by institutional investors like pension funds, which have a long-term view, which means that they will be able to
look at house price fluctuations over the long run, rather than what happens in the next 2-3 years. Because if we're looking at what happens in the next 2-3 years, maybe we will be like, the developer will be like, oh, okay, I don't see sufficient house price growth for me to build. It's high risk, so they do nothing, right? They wait. Because that is a less risky strategy. If you have a long-term view, you might build also in a downturn in which we are at the moment. So there are different funding ways. I know that MHCOG is exploring with the National Housing Bank. But I think the key is to kind of give chance to patient capital, perhaps through some sort of rental products. They were looking at the build to rent. Of course, it has to make financial feasibility, so the returns need to add up. But at the same time, if you're interested in the income element, so the rental element, then you might not require very high returns, which developers might need to have, or private equity funds also might need to have. So I think local authorities might want to look at kind of who they partner with, who they build joint ventures with, and it's important to kind of, look long term. This will also increase the quality of the construction as well.
Brilliant, thank you. Let's try and squeeze in some more questions if anyone has them in the room. Okay, we'll do these two, and if you can try to keep them as brief as possible, we'll try and squeeze answers into them. Thank you.
In terms of the service charges, would there be an option for capitalising the proportion of the service charge above your ownership level? Because then you would only have to pay interest on it instead of paying the whole lot up front. It's just a policy suggestion. And the second question is to do with the new NPPF, which will bring forward the viability assessments, if I've understood it correctly, to before the planning application stage. And this should solve quite a lot of the nonsense that goes on between consent subject to conditions and conditions being applied. But I'm not an expert.
Great, thank you. And there was a question over here for this gentleman.
Hello, I'm John Fender. I'm an emeritus professor at the University of Birmingham. On the issue of how given housing stock is allocated, one thing is the allocation between owner occupation and rental. For a long time, I think the sort of culture has been that owner occupation is the desirable sort of tenure. You know, if you don't become an owner occupier, eventually you're considered a failure, etc., etc. I'm wondering whether this is somewhat misguided. I remember Christian points out that in Switzerland, owner occupation is much less, and one consequence of this is less NIMBYism. So I'm just wondering about the appropriate encouragement or discouragement of rental as opposed to owner occupation, whether, you know, we're nastier now to landlords in both a regulatory and tax sense, whether that sort of policy is misguided and we ought to be perhaps relatively more encouraging towards landlords. And secondly, if I can add a follow-up, the issue of second homes. Again, we're nasty in a fiscal sense towards second homeowners. This hasn't been a long-term policy. I remember 20 years ago, there was a discount on council tax for second homeowners. Now there are numerous fiscal disincentives for second homeowners. So I just wanted to raise the question of how should second homeowners be treated in a tax sense? It may be that the proportion of second homeowners is fairly small in the UK, that it doesn't make much a difference. But I think the question of how second homeowners are taxed is perhaps an important question.
Great, thank you very much, John. Should we start with Stanley on the question about could we change service charges within the shared ownership contracts?
Yeah, and I can say also a little bit about the other couple of things as well. I think we should definitely explore all sorts of possibilities around the service charges so that there is more incentive to to track the progression of service charges over time. I have to say it's very hard as an academic to get data on service charges, especially how service charges change for the same property over time, to really base my comments on any empirical evidence. But I think anecdotal evidence suggests that when you sell the property, new build property, service charges tend to be quite low, not to deter people from buying, and then within a few years they kind of can double. But again, that's not based on any empirical evidence. So I do think that, of course, there are changes to the leasehold tenure, and we're moving to a common hold, but for existing properties, they will stay leasehold. So definitely, I think service charges are a major cost, and we should find ways of, at least trying to predict those costs and anticipating those costs and planning for them. The other thing on the ownership, yes, I mean, I lived many years in Germany where ownership rates used to be around 40%. But it's a very different system, and when I moved to the UK, everyone was kind of obsessing about home ownership, and at the beginning I couldn't understand it, but of course house price growth here is much larger than house price growth in Germany. Up to 2008, there was negative real house price growth in Germany. So there was no incentive really to be a homeowner, and rents were also heavily regulated. Also here, the pension systems are very different. Here we have defined contributions, a pension system. In Germany, you mostly had defined benefits. So I think people see property as kind of a pension insurance. I'm not saying this makes sense really. If house price growth is there and you don't have any other pension coming through. So I think these things need to be balanced out. It's not a simple answer. And in terms of second homes, I agree. I think that there has been second homeowners have been very heavily punished. There are a lot of people that own second homes also for own occupation. So I think, it's been kind of unnecessarily. But I can see that the reason for the policy.
Thank you. We're already over time, but Nikhil, Peter, do you want any last comments on either of these two things?
Sure. One thing, I'll just mention the sort of owner-occupier versus renters. I don't know anything about Switzerland, but I do know about Germany. And a key difference is the regulatory structure for tenants is very different. In the UK, up until basically the last couple of months, you could have been, a lot of people were on rolling contracts and could be kicked out by their landlord essentially at any point in time, which generates a huge amount of risk getting kicked out by your landlord. And so the changing regulatory structure is likely to have a change of incentives for tenants, especially on that side. So we might see some changes. I would also just add that a second home taxation, and this also includes for landlords as well, has only really made sense because of a false scarcity of homes. So if there's a false scarcity of homes, you then tax these. But if there is no false scarcity of homes, then there's no real reason why they should be taxed differently. And I would also just say, I don't generally find myself defending landlords, but with the regulatory change, it is going to make it more expensive for landlords to be landlords, and part of that is related to the court system. So I think probably one of the biggest complaints that when I look at the literature around this that landlords have is that if they have a bad tenant and they want to evict them, up until now they've generally done it under no fault eviction, which is why there have been so many no fault evictions, because fault-based evictions have to go through the court system, and the court system in the UK is not particularly great. So one of the things that I think potentially could have really been pushed actually and introduced in this recent renters' rights bill was potentially, if you are going to tax landlords, that should be hypothecated specifically to a court for the rental market, which means that any issues that landlords have can be dealt with efficiently inside that system.
Great. Peter?
I think on the kind of renter-homeowner thing, I think that there's a sort of implicit bias in the way we discuss these things when we're talking about home affordability. when we're talking about the affordability of home ownership, we naturally kind of focus on that group of people, on that kind of margin between, I'm looking at Christian because we were discussing this in the break, on the margin between kind of being a home renter and a homeowner, so that group of people on the margin of home ownership. And that does sometimes lead to us introducing policies really that penalize landlords in the hope that they'll sell their properties to that group of people, but we might have consequences for the people lower down who are not on the margins of homeownership, who then face higher rents as a consequence. So I think it's partly the way we discuss these things, it sort of introduces a bias towards thinking about that group and home ownership specifically.
Yeah. And we've done lots of work at the IFS on how there's a huge tax penalty in favour of owner-occupiers, I think much bigger than you could reasonably justify under really any set of preferences. But I should draw this to a close because we're running over. Thank you so much to our speakers. Thank you to everyone who's coming. For those of you who are here in London, there is going to be lunch in the room next door, so please do stay, get your lunch and talk to the speakers. But yeah, thank you to everyone.